hold here for a while, but it's very difficult to see why they'd want to go a lot higher from here.
Fed's retaining its optionality. It's not saying we're definitively moving higher, and it's certainly not saying 7%.
It's just hard to see what the positive catalyst is for markets today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Pouring freezing cold water over this summer's Happy Talk. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market is trying to bounce up by 1/3 on the S&P. Yesterday at the close, the lowest since June on the S&P, on the NASDAQ. This morning, Tom, in the FX market, the euro, 105, dollar yen, pushing 150.
Those are the major pairs, but you can look at all the granularity of the foreign exchange market and see the trauma that's out there. It's not a soft landing, it's an abruptness here. And the adverb I'm using, John, is suddenly. There's all sorts of suddenly. Kawa, you weren't here. Luke Kawa of UBS.
What did Luke say?
Luke nailed it. He went all Newtonian on us on Monday. He's talking first derivative, second derivative. And the second derivative, the accelerative force, is in place on this Wednesday.
At some point, Lisa, this Treasury market sell-off becomes self-limiting because of the pain it inflicts elsewhere. Are we nearly there yet?
Well, Chris Verone said we might have to get to 520 on the 10-year before we get to that point. So we still have another 70 basis points to go. In other words, we might not be that close simply because the bulls have been burned so badly they're not stepping in. And we see that again and again. What I find interesting is where the bias in markets is right now. And I think you rightly started with, are we seeing a dash of cold water on the Goldilocks theory? Yesterday, the market moved on a Conference Board consumer confidence survey that came out disappointing. This just shows maybe people are getting a little bit nervous about their positioning around a soft landing and their confidence and strength.
The two data points yesterday that jumped down, consumer confidence lower, house prices higher. Doesn't that speak to the moment we're in, Lisa?
People are getting nervous by how expensive things are getting, and yet they keep buying. And this is the problem that people are really grappling with. Some of these anecdotal feeling surveys don't reflect what people are actually doing, which is not buying treasuries, but buying homes and buying everything else, buying plane tickets, etc.
Chris Verone, a little bit earlier this morning, said things can change when things break, and ultimately something may well break. Something did break earlier this year. The banking system in the United States of America, and Switzerland had some difficulties as well. I want to talk about this story. News in the last 60 minutes. Check out the stock of UBS. UBS is down by a little more than 4%. Here's the story from our team here at Bloomberg, Tom. I'll share it with you verbatim. The US Department of Justice has stepped up its probe into Credit Suisse and UBS over suspected compliance failures that allowed Russian clients to evade sanctions. This, according to people familiar with the situation.
Well, it's the usual chit-chat on sanctions, and you say, well, it doesn't matter, but it matters here for a bank, as Armati said to Bloomberg in Asia a few days ago, under massive restructuring. All the domestic political headaches of Switzerland, you know, dealing with the Swiss people and the government and the cantons and that. But the overlay now is this market that we're describing. As Chris Verone said, REITs hammered. Our banks next.
Consumer discretionary really struggling as well over the last few weeks.
And that's a GDP question.
Big time. Your equity market looks like this on the S&P. Small bounce, up by 0.3% on the S&P 500. We'll get into the equity market and bring you some more on that UBS Credit Suisse story a little bit later in the next hour or so. In the bond market, yields are lower by 2 or 3 basis points. The 10-year back to 450.72. Talked about the FX market already. Has breathed some life into the energy conversation. Lisa, 91.76 on WTI, up by 1.5%.
A terrible mix, as you've been pointing out, for the ECB, but also it raises some questions for the U.S., where this really impedes consumer confidence. I'm watching this. 12 noon, we get Bank of America CEO Brian Moynihan speaking at the Economic Club of New York. This comes after we heard Jamie Dimon talking up, gaming out what the world would look like at 7% rates. There seems to be a bias to rates going higher in all conversations, not crashing down to pre-pandemic lows. After market, we get Micron earnings, which I think will be interesting, especially given Costco coming out with disappointing earnings yesterday. Micron, key for a lot of the tech trade, which has completely supported the entire equity market this year. And at 9 p.m., the thing that nobody is talking about and no one seems to care about is the second debate of the Republican presidential candidates. It'll be aired on Fox News, happening in California. It is interesting, and you mentioned this, John. No one's talking about this, and you're right. Zero buzz. Asa Hutchinson got kicked out. No one cared. 7 people are showing up, not the former president, because he's going to be down in Detroit. trying to speak to the anger among some of the picketers with respect to the auto manufacturers. I'm sure that he's going to try to counter what Biden did yesterday. That's where all the focus and cameras are going to be, not in Simi Valley in California.
Absolutely. Tom, how does that group of individuals on that stage later on get any traction whatsoever?
You got off the plane, you called me in from Middletown, and you said, Tom, what's going on? And I said, you said there's no buzz in this debate. And to me, that's the heart of the matter. I don't sense a buzz out there. I think people have moved on from the drama of the former president not showing up.
Yeah.
It's that simple.
Big time. AMH coming up a little bit later this hour. About 20 minutes from now, we'll catch up with her about the latest situation in Washington and, for that matter, in Michigan as well. With us around the table, Avery Sheffield, co-founder and CIO at Vantage Rock at Rockefeller Asset Management. Avery, good morning to you.
Good morning.
Is it time to buy the stock market yet?
I would be cautious. I certainly would be. I think that, to the points that you've been addressing, look, we are in a period of real uncertainty. We have the 10-year yield continuing to move up. We have pressure in the oil market. We have, as Lisa, as you were saying, people still going out and really buying houses, buying cars, but actually pulling back on some areas in consumer discretionary spending, which suggests they're tightening their wallets because the things that really matter to them, housing, food, energy, transportation, they need money for that. And that creates a dynamic where the Fed is likely, I think, to potentially stay higher for longer until something breaks. Because if something doesn't break, there is a risk that inflation could reaccelerate.
This is a great polarity here. You've got a huge advantage of dealing with Ruchir Sharma every morning at Rockefeller Capital. He's just fabulous on the greater global view. And on the other side, you came out of Wharton and your first job was the glory job of Wall Street, writing the black books at Sanford Bernstein. You do security analysis granular. How do you combine Ruchir Sharma's worldview with the discipline you learned at Sanford Bernstein? How in God's name do you do that?
Right. Well, it's a lot of fun every day, and working with people like.
You're having fun in this market.
Yes,
okay, there's your banner, Sheffield having fun while the rest of us are going down in flames. How much fun is it?
Well, it's very dynamic and always interesting, right? So you always have to put on your macro hat every morning. Your Ruchir Sharma hat, and then have the discipline of security analysis, to your point. But deciding, what the inputs are into those models for anything that has any cyclicality, which is a lot of the market. We're not just a healthcare fund or a utilities fund. It's very important to understand what you think about interest rates, what you think about oil, and as inputs to decide how to value a company.
What's the haven trade right now?
The haven trade. So I think that inexpensive defensives are probably the safest place to be.
Which is what?
We do like insurance. Insurance companies that have conservatively managed their balance sheets have the benefit of higher rates, and still in a harder market, specifically in reinsurance, I think is more interesting. We also do like telecommunications from here, just given that it looks like the competition from cable we think is lightening, and you're getting paid over 7%. And I think people forget that earnings of the major telecommunications companies are up since 2019. Maybe not up as much as other sectors of the market, but they're not like these dissolving entities that the market's pricing them for.
What's interesting to me is you didn't say bonds, even though we're seeing incredible yields.
Yes.
You didn't say the dollar. You didn't say some of these other hedges that people are going to. You didn't say energy. Where is sort of some of these other calls that people have said traditionally have been havens, traditionally have been the staples? Right.
So I would say we are an equity long short fund, so I don't trade bonds. I do think yields are interesting here. I think that it's interesting. As a bond holder, you're worried, are yields going to 5%, 7% over a longer period of time? I think there's a great return in yields in bonds here today. Higher quality you get paid for. Treasuries short into the curve seems like a pretty safe place to be. We also do like energy. We are constructive on energy as well. The energy could get tied up in a cyclical trade to the downside at some point, but given OPEC has so much control, I think fundamentally energy is likely to be higher for longer as well.
I still haven't gotten over the death of Jonathan Gray of Sanford Bernstein years and years ago, but you had Jonathan Gray on SNL and Brad Hintz on the big banks. You were weaned on that. What do you do with the banks here of all different capitalizations?
Yes. So I think they're tricky if we manage through this in a decent way. There's probably long-term value in some of the banks. Near-term could be harder, but look, the regulatory regime is out to get the banks. I mean, as Jamie Dimon has said, so I think you want to go for higher quality banks if you're going to own them, but we're mostly on the sidelines. We do like some of the European banks, some stalwart banks here in the United States, but I think the environment is tricky for them. So the U.S. banks might be kind of more in a holding pattern, but we're definitely a prepared mind for any opportunity that things are getting better.
A prepared mind. It's a Brandywine phrase. We're in a prepared mind.
Can I ask you a long-short question based on where crude is right now? Do you have more confidence being long energy or being short consumer discretionary?
Long energy because we're not priced for it, right? The energy stocks are cheap. The E&Ps and their suppliers are very inexpensive. Within consumer discretionary, we do have some modest exposure because you do have some companies that are pricing in a very dire scenario. But you still have a lot of consumer discretionary, especially on the growthier side, that's very expensive going into or continuing to see pullback in spending. So I think you have to be very valuation sensitive in this market with yields, short term over 5%, longer term over 4% here in the U.S.
Given we've identified quite a few sectors that you do like, when you start a conversation by saying you don't really like equities, are you just saying you don't like the valuation of 7 of them, which make up the bulk of the S&P 500?
Right. Well, it's a lot more than 7 of them, right? And actually, a couple of those 7 are actually not that expensive and very high-quality businesses. So you're lumping them all together, but there's a lot of valuation dispersion in there. The market as a whole, right? You have the S&P trading at 18 times. You have on forward earnings. You have the Nasdaq over 26. The S&P's PE has gone up 10% since a year ago. The Nasdaq has gone up 20%, while the treasuries, short-term treasuries have gone from over 3.5% to over 5.5%. So it doesn't make any sense. But you do have some areas in consumer discretionary, in energy, and even insurance and other areas in the market where valuations are very reasonable.
Avery.
Telecom as well, sorry.
Thank you. Thank you very much. We'll continue this conversation later on this year, no doubt about it. Avery Sheffield there at Vantage Rock at Rockefeller Asset Management. If you are just tuning in, welcome to the program. The S&P 500 right now positive by 0.4%. Catching up with us a little bit later, next hour, 8 a.m. Eastern Time, Nadia Lovell of UBS Global Wealth Management. We'll continue this conversation. The multiple expansion in the face of what's ultimately developed to be a bad year again, Lisa, for treasuries, with yields higher, higher, higher.
A third year, and I keep hearing this until something breaks. And we were talking about that something would break at 3%, something would break at 4%.
Well, something did, right?
Right. Well, for a hot second, and then it didn't break anymore, and suddenly we're back to 4.5%. And you got to wonder, okay, well, what's it going to be? Because when you ask someone, if they say, well, I don't see it quite yet, maybe commercial real estate down the pike.
We had some pension fund issues in the UK.
Dealt with
about a year ago. We had some banking issues, some real banking issues in the United States this spring.
Well, this is important.
How well dealt with have these issues been?
You think as hard as you can. I always have in my head the number one thing I've ever got wrong, which was the collapse of Boris Yeltsin in Russia. I completely screwed that up, 100%. What's the thing out there? I'm thinking as hard as I can. I'm thinking almost as much as Avery Sheffield. I'm just got my eyes squint together. I'm in a meeting with Rishi Sharma, and I'm like, what could happen? And the answer is you never know what it is.
Is that the face you pull in meetings?
Yeah, you put this in, you're in your meeting, and you're like, Rishi, what's China going to do? Forget about it. The answer is you never know what it's going to be, John, but we're there.
It's true, TK. It's true. AMH down in Washington, D.C. coming up next. Live from New York. Equities up by 0.4%. Treasury yield just a touch lower. We're down 3 basis points. Still, to see your 10-year at 450.31 is quite something. From New York.
Manchester United could win a game. That could be it.
That would be quite something,
that would
too.
Be something. Yeah.
This is Bloomberg.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Picket lines when I was a senator since 1973, but I tell you what, first time I've ever done it in prison. Okay? Well, look, one thing is well slip on, to be very brief. The fact of the matter is that you guys, UAW, you saved the automobile industry back in 2008 and 2004. Made a lot of sacrifices, gave up a lot, and the companies were in trouble. But now they're doing incredibly well. And guess what? You should be doing incredibly well, too.
What a scene, what a moment in the last 24 hours. The President of the United States, Joe Biden, on the UAW picket line in Wayne, Michigan. Live from New York City this morning. Good morning. Your equity market just about positive by 0.4% on the S&P 500. The headlines in the last week, all in the bond market. Yields at cycle highs over the last few days. Your 10-year 450.31. Yields coming in about 3 basis points. I can tell you, Bob Michael at JP Morgan Asset Management with us around the table in New York in 13 minutes' time. Just want to check in on UBS. We'll have more on this story for you a little bit later on this morning. That stock in Swiss trading is lower, hit hard, down by around about 4% off the back of our story here at Bloomberg that reads as follows. The US Department of Justice has stepped up its probe into Credit Suisse Group and UBS as well over suspected compliance failures that allowed Russian clients to evade sanctions. This according to people familiar with the situation. Our story, Lisa, this morning goes on to read that what began as a series of subpoenas sent to a range of banks early this year has developed into a full-scale investigation focusing on Credit Suisse.
What I find interesting, two things. First, you mentioned this morning, that UBS voluntarily gave up the government backstop against any potential liabilities from Credit Suisse, which raises a question of what kind of liabilities they're going to have. But the second thing is UBS wants to expand in the U.S. The U.S. is one of the opportunity markets for this bank. What does this do to that if they're going to be painted with the Credit Suisse brush and a negative one at that? It's sort of a growth prospect in addition to potential liabilities.
It's another headache. It's just another overlay here on their global struggle. And, you know, as Armadi rather told Bloomberg, in Asia, they got a battle with Asian wealth management. How many headaches do they have? 5, 6. Add another to it. It's that simple.
And many, which is why the price was what the price was.
And
right?
we're advantaged at 5 a.m. here worldwide out of New York. 5 a.m. The Irish import with us. Manus Cranny's encyclopedic on this.
That is true.
You know, he's like
Cranny nearby.
Unlike me faking it, he actually knows what he's talking about.
I think that applies
I can't
to all three
understand
of us.
his accent, but that's a separate issue.
TK, that's rude.
It's not rude.
That is rude.
It's Irish. You know, Manus and
that is.
He can't understand me as well.
That is rude.
That advantage.
I can understand him. He sounds fantastic.
I feel Manus Cranny's pain right now because I've lived with this for years. Tom will say I can only understand every other word coming out of John's mouth, which is also
no, it's
rude.
about every 3 out of 4, maybe 4
every 3 out of 4.
Yeah,
is that where
true.
things have improved?
Yeah, things have improved.
Good.
You're
Good.
very, you're very
Thanks,
American.
TK. Thank you very much.
In Washington, Anne-Marie Horton, our Bloomberg picket line correspondent, joins us right now. Anne-Marie, those are historic images. There's no question about it. Sum it up. What did the Beltway think of the president's appearance on the picket line?
Well, it was unprecedented. As you say, we haven't seen images like this. He was carrying a megaphone, talking to auto workers, telling them that they should keep at it, keep asking for it. Even when a reporter said, should they be asking for a 40% pay rise? The president says this is what they deserve, and they took sacrifices and kept these companies running during the depths of the financial crisis. But to that point, the president is also walking a fine line on that picket line, because remember, A big issue the UAW has with this administration is the billions of dollars of federal money that is being sent out to help electrify the grid. And we talked to Jared Bernstein yesterday, and I asked him, isn't this the crux of the issue? Isn't this very difficult for the president, given the fact that they are very annoyed, it is very obvious, about this money that's going to EVs? And he said it's not a foregone conclusion yet that those EVs will not be produced and made by non-union workers. But the fact of the matter is you're going to need less individuals to make an EV, and a lot of the money we've seen going towards these EV plants are in the South, and this is just not the culture for union workers.
Anne-Marie, balance of power question. Does President Trump need a megaphone?
Well, President Trump, I think, is going to have a very different look. He'll be doing more so of his typical rallies. I doubt Sean Fain, well, I know Sean Fain will not be standing next to him, whether or not Sean Fain maybe goes up and actually protests the former president being there. Remember, Sean Fain has come out and said it is individuals like former President Donald Trump that we are actually standing for, that billionaire class. So he will have, I think, a classic mic and podium. He will not have a megaphone.
Breaking news. There's a GOP debate a little bit later. Anne-Marie, nobody's talking about it. Lisa mentioned that about 15 minutes ago. Yeah. How are those guys, that group of individuals, going to get any traction whatsoever?
Well, they're going to have to try to figure out a way that they can break out. Trump will be doing his own counter-programming in Detroit, in Michigan, in a huge swing state that he was able to flip in 2016, but he obviously lost in 2020. This is a moment where a lot of focus will be on DeSantis, who I think he had about the middle of the road in terms of timing he was able to grasp on the last Republican debate, and a lot of people weren't going to come after him. Donors have been still waiting on the sidelines to see whether or not he can break out. Tim Scott is going to try to break out. Recently, you have seen some of these Republican candidates start to attack the frontrunner, former President Donald Trump. For Tim Scott, it has been about abortion and saying that the former president looks to turn his back on the pro-life movement. Then you have Nikki Haley, the UN ambassador, former governor, another South Carolina individual. She has attacked Trump at that first debate. She'll likely do it again because they're going to be asked about the shutdown, about fiscal health and fiscal priorities of what her administration would look like. You know, and she attacked the Trump administration for adding $8 trillion to the debt. They're going to try these moments to break out, but it's going to be very difficult given what we see in the news right now with the looming shutdown in Washington and then with the former president taking center stage in Michigan.
Based on some of the polls I've seen, Anne-Marie, I'm sure you've seen the same ones, Nikki Haley does quite well on the head-to-head at the national level against President Biden. What is she achieving at the national level that she's not achieving when it comes to the primaries?
The issue for the primary with all of these candidates, and I think one thing is important, actually, Paul Ryan, the former Speaker of the House, was at a fireside chat yesterday at a university and actually said you have to look at state-by-state polls. And some state-by-state polls, you can see these individuals doing very well, less so than you see them doing, less so than you see those numbers reflected on the national polls. But the issue they all have is that the former president holds 30% of this party and this base, and we've yet to see anyone coalesce around that number 2 that could potentially take the remainder of that 70%, 60% of the party to get them through. And that's the issue they have right now. Even if they do show they would poll very well in a general election, they still have a Trump problem in the primary.
Is the debate between Governor Newsom and Governor DeSantis going to get that much more attention than the Republican primary debate? What was the genesis of this? I mean, how is this going to go over? How do we understand what this is?
Which one? The governor to governor debate? I believe that was Newsom's idea. He sat down for a very long, extended interview with Sean Hannity over the summer. And I believe he said he'd be willing to debate Governor DeSantis, take him head-to-head about what's a better state, California or Florida. And then Sean Hannity, to his credit, was able to get it done, and that will be happening at the end of November. I think it'll be a fascinating debate because potentially these two individuals, whether or not it's this cycle or future cycle, could be head-to-head for the presidential. I
wonder, Anne-Marie, how impressed the administration is with the potential for this debate.
Well, I'm not sure that they're going to weigh in on this just yet, but they do talk about how, Gavin Newsom is going to be there this evening in Simi Valley at the Reagan Library. He's going to be the spin doctor for the Democrats. So they do use him as an individual that can be a strong surrogate for this administration. He is asked constantly, and Jonathan, I know you saw that Sean Hannity interview.
Yeah.
He was asked constantly by Sean Hannity, and he said, I am not running. I back President Biden.
AMH, thank you. Anne-Marie, on the latest down in Washington, D.C., I did watch that exchange between Sean Hannity and Governor Newsom, and I can tell you Hannity is a tough interviewer, TK, as you know well. Governor Newsom did a really, really good job in that conversation. Seriously, if you haven't seen it, engage with it. Have a little look at it. He did a fantastic job with Sean Hannity.
Particularly for our international audience, a lot of the credibility here is not celebrity garbage in that. It's actual skill sets, and Mr. Hannity has been like that across the aisle as well.
Governor Newsom was sharper than I expected in that conversation, far sharper than I expected. Coming up on this bond market, this guy, Bob Michael of JP Morgan Asset Management, weighing in on some major historic moves in the Treasury market with yields at cycle highs, a 10-year at 450. Live from New York City, equities up. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Getting back to June lows in the equity market, trying to bounce off those lows right now on stocks. On the S&P, on the Nasdaq, we're higher by about 0.4% on the S&P, up by 0.42% on the Nasdaq 100. Thanks for that contribution, Tom. In the bond market, 2-year, 10-year, 30-year, TK, these moves right here. Yields a little bit lower today, but much, much higher over the last few months. Let's call this 450 on a 10-year, 450, 10 right now on 10s. On a 30-year, Tom, your 30-year in the 460s. It was only a few months ago where being in the 440s was worthy of a headline. We're now in the 460s.
Those are the single yields, a nominal yield. Again, I look at the inflation-adjusted yield, the shock of a 2.22% and how quickly we got there. But, John, what's interesting is that vanilla spread, the difference in yield between the 2-year and the 10-year. And the phrase the pros use is disinverting. And most experts will say it's not the depth of the inversion. Think of Priya Misra and all she did a year and a half ago. It's when you turn and disinvert, and that's what's going on right now.
And it's been led by the back end. Best evening.
Yeah.
Yields high, Lisa. Cycle highs yesterday, your 10-year, 456.22. The close yesterday, 453.56.
Where are the buyers? And that's my question. There have been so many people who are talking about how much they like yields at this level, including our next guest. And I'm wondering at what point you start to see the action, the sort of vigilantes on the other side saying, yes, yield finally, and coming to the market and actually doing some bulk buying.
Well, we're seeing the action in the FX market, that's for sure. Yields up, dollar stronger. Here's two currency pairs for you. The euro against the dollar against the yen. The euro breaking down to 105. Dollar yen breaking out towards 150. That's a stronger dollar story, weaker yen, weaker euro. TK, keep going back to your question of the moment. At what point does the BOJ start making not just some noise, but start doing something about a much weaker Japanese yen?
Yeah, inside baseball, I don't want to go all Rudy Dornbush on you, but the answer is every sequential intervention you do, the theory is less efficacious. So they've already done one ballet. The next ballet is presumed to be not as effective and takes more ammo to get the same effect.
Do they back away from negative interest rates towards year end? That's where the conversation kind of was a few weeks ago. Sure. The yield curve control, what they're willing to tolerate, all of that, good stuff, bad stuff, whatever that might be. Under surveillance this morning, here's your first story. A US government shutdown nearing its Saturday deadline. Despite incremental progress, the Senate introducing their own bill that would extend funding to November 17th, but no clear path for the bill to overcome a deadlock in the House, which is set to vote on its own measures. Lisa, you're in charge of this one.
Oh, great.
Explain this.
It's a mess, and basically the Senate is trying to force some business to get done without the shenanigans of what's going on and without putting a House Republican Speaker Kevin McCarthy on the hot seat and potentially being voted with a lack of confidence vote. What I find interesting is markets profoundly do not care. The answer to this is to keep buying the dollar. The dollar is a place to go, even though it looks like Washington's a mess, as always, yet again. And that, to me, is the story, that basically people are shrugging this off despite some of the jawboning that this time will matter.
Okay, here's another question. Does that story have some similarities with this story? The U.S. Federal Trade Commission taking Amazon to court in a new antitrust case. The e-commerce giant accused of monopolizing marketplace services and illegally forcing sellers to use its services in exchange for better listings. This is the fourth suit the FTC has filed against Amazon just this year. Lisa, the company responding saying the agency is, quote, wrong on the facts, wrong on the law.
And Lena Khan, who heads the FTC, has not been very successful, let's be honest, in some of her plays to get some antitrust actions against some of the tech giants, which has been her cause, frankly, since law school, right? This has been something that she's been really hot on. What I thought was interesting is Amazon shares were down 4% yesterday. These are the cash cows of the market, and they continue to be the resilient market players simply because they do have so much of the market and they can exert this kind of power.
Surveillance, dumb question. If assuming Trump-Biden, if Trump wins and Lena Khan has shown the door, what happens? I'm asking.
I imagine there'd be questions about whether this would continue or not.
I remember the day where the Justice Department walked away from Microsoft, and then it was like, well, that took long.
How many times have we heard this? What ultimately addressed the Microsoft issue?
You can't do a thing on my boat.
The market did.
I can't remember.
Yeah,
the market did.
But in fairness, I mean, she's not totally doesn't have a point. I mean, if you take a look at this idea,
almost says she's not wrong.
Well, I mean, if you take a look at what's going on, Amazon penalizes merchants that have different prices that are lower on other sites. There are whole sorts of things. What do you do with a company that is the market?
Here's the fact. I have my cell phone. Someone in the house in the West Wing is saying, we're out of this. Watch. Boom.
Boom.
And those
done.
prices are getting more expensive.
Well, that's the change.
That's the change.
A few years ago, could you make the argument it was hurting the consumer? I'll speak for myself.
Not a chance.
Not from my perspective. I was doing pretty all right, doing okay, going through Amazon. I'm with you. Over the last few years, it feels like maybe you're not getting your better prices from that particular platform.
And merchants are going out of business because they're not making a profit. And that's the other flip side of the story.
Let's finish on this story. Hollywood writers getting back to work this morning after reaching a deal with major studios. Union workers getting a 5% boost in minimum pay, more viewer data from streaming services, and more protections against the use of artificial intelligence. WGA members will vote on the new contract by October 9th. Actors from SAG-AFTRA remain on strike. So making some progress here, Bramo, but not completely.
And not completely, and I thought it was interesting what was on the line, artificial intelligence, and they're going to get some royalties, even if artificial intelligence fills in the gaps of some of their plot lines.
Is that where all these plot lines are going to come from now? Just AI?
Well, no, they're going to generate something, and then
Ask
AI will be like, this is what you were going to say.
Right,
Really, and ChatGPT is going to be like, do you really think that's a good idea? Maybe just, tweak this ending. This character seems disingenuous.
The future, Tom.
In 2011, I joined a guy named Mohammed El Arian on the stage at the Fixed Income Analyst Society as he was wandered into the Hall of Fame of fixed income. Folks, on Wall Street, this is like a ginormous deal. Names like Dan Fuss of Loomis Sales, Ed Altman, who was one of my first, the Z-score and all that. A guy named Fabozzi. It was inflicted upon us at gunpoint to read this. Roger Ferguson, he did okay. And every other name, it's a who's who here of fixed income.
There's a new name.
Joining us with a new name is Bob Michael, CIO, JP Morgan. No, forget about the title. Hall of Fame member, congratulations.
Thank you. It was
Congrats,
a special
Bob.
night last night. And by the way, Barbara Novick from BlackRock was an honoree. And your own, Steve Berkley, the godfather of the entire fixed income index business, was also an honoree last night. So it was a very special night.
Can I just speak to how modest Bob is, Tom? That he came in this morning, and I knew where Bob was last night for this event, and Bob came in and said, I was at a meal last night, and he starts talking about a calculator. I'm sitting there thinking, TK, not just any meal. Not just any meal.
And you pushed him, and he didn't even say it.
There's so much within the bond turmoil right now. We'll just take a few seconds here. You and I were weaned on the same book. Sidney Homer, who's in the Hall of Fame, and Marty, and the yield book. I mean, tell us about what that book did to you and me, how it straightened out our head about discounted cash flows.
So true story. I heard Marty might be there last night, Marty Leibowitz, who co-authored that book. I have my original copy of the book. I kept it at home. I looked at it for weeks, and I decided not to bring it in and have him autograph it because I was afraid he might open it and see I underlined the wrong things in it. but he was there. It was star after star. So for me, very, very special.
Very cool.
It's a key moment right now in the bond market, and I'm so glad that you're here. Because you've been one of the buyers and saying that it is an incredible value in the 10-year, pushing against the grain right now. How much conviction do you still have, despite some of the moves we've seen?
I have increasing conviction. And I will admit, for bond buyers, we've been swimming upstream here for the last couple of months. And I go back and I look post-Silicon Valley Bank, and we all looked at the market and thought from March to June, we're going to have a pretty significant retracement. Let's sit out of that. I think what's been the surprise is from June to this past week, rates have continued to go up. And the narrative has become it's more of a soft landing. You look at the fiscal impulse that are coming from all the acts, the Inflation Reduction Act, the Chips and Sciences Act, and a couple of the others, the Infrastructure Act. And they're all rippling through the system, but what we're seeing is the underlying data continues to get worse. We look at the consumer that continues to get stretched, and we think that buying duration in here, we're about to start swimming downstream again.
How do you understand the market moves? How do you understand where the bet so far has gone wrong, given the fact that yields have gone up much further than anyone thought was possible in this cycle after so many people called this at peak yields?
Well, I'm not so sure about that, and I've gone back and looked at the previous cycles, And actually, we should have been more surprised if we didn't get this back up in yields. And it's happened every single time. You go back, and about the same magnitude, 50, 60 plus basis points. We went back and we looked at the end of the Fed hiking cycle in 2006. Yields fell dramatically. And then they went back above the 5.25% high in June 2007, right before these enhanced cash funds started shuttering. So it takes time. And then, by the way, they went back in June 2008, they went up 100 basis points from their low in March 2008. So until these long and variable lags hit, you're in this never, never land of something that feels like a soft landing. You're not getting more rate hikes, you're not in recession, and the markets will oscillate back and forth, and you'll have this battle between the Fed's done it, they've engineered a soft landing, they'll congratulate themselves on that. They did it this time through their summary of economic projections, and people like me say, look at the underlying data, everything's cracking.
And then bad things happen. You can't throw around 06, 07, 08 without really giving us an idea of the kind of things you're concerned about. Do you see things going badly wrong, or just the ultimate run-of-the-mill recession that we're not used to?
Well, you touched on them earlier. It's not true that these rate hikes don't have consequences. We almost took out the UK pension fund system and the US banking system. When you look at the Bank Term Funding Program, it didn't backstop regional banks, it backstopped the entire banking system. We're looking at a couple of things. We're looking at the consumer facing depleted savings. So the excess savings from the COVID fiscal transfers, those are gone. And now they're facing the higher cost of everything. They're facing higher energy prices, which are going to dip into consumption elsewhere. We look at temporary help services jobs. They've turned down. They've never turned down before, except in advance of recession. And we looked at home price affordability, housing affordability. Kelsey Barrow and I were talking about this morning. It's the worst on record. Now, the date only goes back to 1986, so I don't know before that, but the combination of very high home prices and the cost to finance them, we've never seen it. So when you hear about the current generation talking about how hard it is to buy a home and how inexpensive, they're 100% right. We've never seen this before.
Bob, this is great. We're going to continue this conversation. If you are just joining us, welcome to the program. Your equity market on the S&P 500 positive here by 0.3%. In the bond market, we talk a lot about yields, a 10-year at 450.92. Bob, there's some long-dated stuff at the moment. We've touched on this. A 30-year Treasury issued only a few years ago that's trading something like 50 cents on the dollar. Someone's holding that. We know the Federal Reserve is. Of that particular issue that's been referenced a lot based on our reporting here at Bloomberg, I think about 19% of it is held by the Federal Reserve. You said to us something you didn't anticipate was the actions of the Fed after the banking difficulties of spring were the equivalent of what happened with TARP, that it was that kind of moment. Are we not going to see additional stress in the banking system based on some of these moves, these incremental moves, the additional moves we're seeing in treasuries over the last few weeks?
I think you have to anticipate that the entire banking system hasn't been solved yet. There's been a Band-Aid put over it, but right now you're sitting with a whole host of regional and community banks where their securities portfolio is now further underwater. Sure, they can post it to the Fed and get 100 cents on the dollar, but that's been used to meet deposit outflows. We look at the amount of money accessing the Bank Term Funding Program, it's still around the highs at $108 billion. You also look at their loan portfolios. Those are also quite low now.
Let's continue this conversation. The brilliant Bob Michael of JP Morgan Asset Management on the banking system and on US corporate credit. That conversation continues. Live from New York City this morning. Equities up by 0.3% on the S&P 500. Good morning.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
These increased costs and these cost pressures underscore the importance of the Federal Reserve's efforts to fight inflation, which can complement efforts to address other factors affecting rent prices, including increasing the supply of rental housing.
That was Michelle Bowman, the Federal Reserve Governor, weighing in on Fed policy in the United States. Live from New York City. Welcome to the program. Your equity market on the S&P 500 positive here by 0.3% on the S&P. A little bit of a lift here. Yields coming in a couple of basis points, 450.72. Does 60-40 work? So this was a big question, wasn't it?
Good question. Yeah.
It's a problem.
Yeah.
Treasuries down, stocks down, treasuries up, stocks up.
It's not working. It's not working yet again. And there is a question of whether we understand the bond market. And right now, a lot of people have been saying, well, it's technical, it's structural, it's this, it's that. Maybe yields can go even higher, trying to explain something that isn't cohering with the traditional logic of the past 10 years.
In 1996, Fixed Income Hall of Fame, a guy named Fisher Black, he did well, tragically died way too early, and a guy named William H. Gross. From 1996, and Black Gross at that Hall of Fame, Lisa, we've had the great moderation. Like on a sailboat, and I'm not a sailor, it's like the wind behind you, or, you know, there was a band called Mountain, and they had a great song called Nantucket Sleigh Ride. It's a Nantucket sleigh ride where the wind's really helping you out. That's what we've had in the bond market for 20 years.
And now as we get back, who is going to emerge the victor at a time where you're finally getting yields?
Well, something we mentioned, the unrealized losses, Tom, here in the bond market are just ginormous.
Yeah, ginormous is the right word.
In the U.S.
That's
banking system,
seriously.
Absolutely ginormous.
You can't add them up on a calculator. Here's Bob Michaels and my calculator. This is my personal HP 12C with CFA sticker here. And Bob, you used to have this, or Bill Gross had a Monroe Trader at his desk and all that. All that's out the window now. Here's what our audience knows and what you're dealing with at JP Morgan every day. The Vanguard Total Bond Fund is down something like 21% from the Great Moderation peak. It's down 7.5% annualized. That's what our audience is feeling. How do they turn that around? Leave bonds?
I'm all for that we're at an inflection point in the economy and the bond market, that the last 15 years were not normal, that we got to a structural low, that was it, and now we're going to revert to something that's more normal, where maybe that first long-term Fed dot at 4.25% will be the neutral Fed funds rate. I just don't think you get there all at once. I think it takes time. It took 27 years for the Fed to get from 20% to zero. Maybe this time we go from 0 to 5 1/4. Things slow down. They have to come back to 2.5 to 3. Next time they go to 6%, and then we figure out what that range is. We've gone too far already.
You're in an office with a guy named James Dimon, and these are huge questions with a lot of zeros to the left of the decimal point. Is the great moderation over? Bring up the banner again, BND. This is the Vanguard Index, and this is what our audience is feeling. They've been hammered 21% from the peak, 7.5% annualized off the Bloomberg. What do you say to Jamie Dimon about this hope and prayer of getting back to the great moderation?
We all hope that we moderate at a reasonable level of interest rates. And I would hope that not tomorrow, but say 5 to 7 years from now, a 5% 10-year Treasury is normal, not 1.5 to 2% where we were. It's just going to take time to get there.
And this is so important, Lisa. 5 to 7 years is not in the vocabulary of financial media and global Wall Street to a great extent.
Although I did hear I should start paying attention to the possibility of 7%.
Yes, I was just going to say that. What did you think about that? Did you go over to Jamie and say, what are you thinking?
You volunteered this moment.
Exactly. I was going to go there, but you actually made it easier.
It is a reminder to me that I sit here and I think about, could the Fed go to 5.5%? 5 3/4? They may just do one for decoration. Could they go to 5 3/4, 6%? No. By the time you get to that meeting, and I'm glad to know that the guy sitting on the top of the house is thinking, you idiots.
Okay, good.
What if all this liquidity hasn't been wrung out of the system? It reignites, and we do get up to something like 7%. It happened in the 80s. So he's running the whole show. And I'm grateful that he's thinking about those things. And I get to go back to my little world of, is it 5 3/4 or are we stuck here?
So basically the lead is here. You respectfully disagree with Jamie Dimon. You'll let him worry about 7% interest rates, but that's not your range in any way, shape, or form.
Well, I think he's pretty clear. That's a stress test. I don't think that's his base case scenario.
As we game out how to understand long and variable lags, you did talk about that. And I think that that is one of the questions that we keep hearing about with the likes of Jim Bullard, the former St. Louis Fed president, saying that we've already seen them and that there might be shorter and they might have worked their way through the system much more quickly. How do you push back against that, especially at a time where you do have highly financialized markets that do respond to a Federal Reserve, forecast what it's going to look like, and have already been adapting to this reality for a year, more than a year?
I would have waited until 2 years passed from the period of Fed hikes to see whether those long and variable lags hit, because the Fed's own studies show it's 18 to 24 months. And here we are about 12 to 18 months into it. So we should just be starting to see that. I disagree. I don't think they fully hit. I think we've only seen the front edge. You talk to anyone in corporate America, the big companies have already termed out their debt. They have to go back and refinance that. You talk to anyone who's looking at a home, they can't get a mortgage at 3%. They're in that close to 8% category, and those people who own homes, if they need to move, they're going to have to step up their mortgage. The cost of financing autos has gone up, and we've seen through the Chase credit card data that revolving credit usage has gone vertical, and that's at a much higher cost of funding than before. So that is telling you the consumer's already stretched here. They're trying to maintain their level of spending, and it's going to cost them more when they put it on credit.
We've been seeing this, and we've been hearing the acknowledgement of this for people who still are not buying treasuries right now because they're saying that prices are still going up. Yes, the housing market is broken, but house prices are surprising to the upside. At what point do you say that inflation can stay here, that benchmark rates can stay here, even with a downdraft that's being felt and recognized by the market?
Well, I think the end of this week will be interesting because on Thursday we get benchmark revisions to GDP. We expect those to be lower. So that will raise into question how strong the economy is. Then we get personal consumption expenditures on Friday. We think that while the year over year may come down below 4%, you could have another 0.2. Now you start to print a string of 0.2s, which is bringing inflation pretty close to the Fed's 2% target. As long as those growth and inflationary pressures, the trajectory is down, at some point, the Fed's policies will look outdated.
Question from a Bloomberg subscriber. Bob, let's finish with that. Unless the Fed steps back into the market via QE, who's going to take down the duration supply next year? What's the answer to that at the moment?
We get inquiry every day from retail platforms and from institutions wanting to know, is this the time to go into bonds? And there's been a lot of flow at the start of the year, but I think it's only been at the tip of the iceberg. I think there are a lot of pension funds and insurance companies that are looking at one of the best opportunities to de-risk in 20 years. They put some money to work. They've got a lot more to do. There will be plenty of buyers out there.
Out of interest, what's holding them back? If I told them that they could have these yields a couple of years ago, they'd been like, really? Like, can I take that now? What's holding them back now? Here it is, 460.
I think everyone's concerned about catching a falling knife. And I think at the start of the year, when they put money in, yields rallied very rapidly and they pulled back to see if you would get a pullback. They pulled back a bit, and over the summer they put some in, and as yields have continued to go up, they've just paused.
Ian Lingen publishing moments ago, Bank of Montreal, it goes to the same illusion. Christopher Owen had this earlier, the stochastic idea of catching a falling knife. What is the signal out there? Is it Fed rhetoric or Jerome Powell policy, where all of a sudden you go from the fear of catching the knife to something else?
I think you've got to see something which evidences a material slowdown in the economy. I think everyone's comfortable with the disinflation narrative, but concerned that there's a lot of data in the labor market that looks strong. When we start to see the labor market come under pressure, that will turn the tide for sure.
Bob, I've known you a long time. Always enjoy catching up with you. Congratulations.
Thank you very much.
Inducted into the Fixed Income Hall of Fame. Bob Michael of JP Morgan Asset Management. Very cool. Live from New York City, Nadia Lovell of UBS up next.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
The market is going to look past some of the shenanigans in Washington and focus more on what the Fed is doing.
Inflation has been trending pretty rapidly lower, much faster than the Fed expected.
Yields have moved higher, even in the face of this sluggish economic growth.
That is the risk for the fourth quarter, is can the consumer continue to surprise on the upside?
Consumers are spending, but they're filing for bankruptcy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We're together again in New York on radio, on television, and markets on the move. We'll do more this hour on the data check. Really extraordinary to see all the linkages. And John, one correlation today, unlike Monday and Tuesday, is oil lifts 95 Brent.
And we talked about that toxic brew, Tom, to see Brent at 95 and the euro at 105. So that means euro weakness and energy strength. The oil importers, TK, the pain that they must be going through right now with this mix of a strong dollar and higher energy prices.
We've covered this all morning, and we can do we'll do the data here. We'll do a little more data for you this morning before we get to Nadia Lovell on the equity markets with UBS Global Wealth. But John, I look at where we are, and I go to a tangible study, like talking to Bob Michael moments ago of JP Morgan about tangible things. Oil, you mentioned, dead on. Real estate is a tangible asset. It's not some fungible thing like Apple shares, OMG, bear market.
Well, let's get to the OMG at 450 on a 10-year, on a 30-year at 465. And Tom, let's ask the question, where are the buyers? Gargi Chowdhury of BlackRock said yield of dreams at the start of the year. This is the stuff people dreamt about years ago.
Yes.
They've got it in front of them. Why aren't they buying it? Bob Michael, JP Morgan Asset Management, 5 minutes ago, they do not want to catch the falling knife.
Lisa, I look at this, and this is your window, and I look at the Bloomberg Total Return Index, the ex-Lehman Brothers indices, and it's unimaginable that the price can break down below that trough of, I'm going to say, a year ago, and yet it's getting there. We're getting close to OMG, new low prices.
Yeah, we're poised for a third straight year of losses on the broad bond indexes. And it was funny yesterday when you talked to Kathy Jones and you said about falling a catching knife. Are you falling a catching knife? And she said, we don't like to fall catching knives here. We leave that to the equity folks.
It's in the
she was
zeitgeist
joking.
this morning. Verone,
right,
Lingen, Jones, all of them.
There is a question then, what's going to trigger a reversal? You know, what's going to trigger the people with conviction that yields will go down, maybe not back to where they were pre-pandemic, but that this still is the yield of dreams and not a precursor for a very new era with substantially higher, dare I say, Jamie Dimon type rates.
Are spreads giving way?
A little bit, particularly a little bit, but not catastrophically. This is the sort of shocker for a lot of people. It's why have you not seen bigger dissonance, bigger sort of dismay expressed in the credit market? You are seeing in high yield, though.
What's important here, folks, is the three of us all look at different tea leaves to indicate the stresses out there on a Wednesday morning. John, what's your number one tea leaf?
Well, I'm with Lisa. High yield spreads are still south of 400 basis points, looking at the index that I follow. They're still historically very tight. Very, very resilient. Lisa was exploring what changes this. It's the data. It's certainly not house prices going up. It's not unemployment still south of 4%. It's not jobless claims around 200K. When that data starts to change, that's when you get on the call, on the phone, 1-800-BOB-MICHAEL, and you're like, yeah, let's go. let's go. And you just don't see that yet in a big way.
I go to tangibles and particularly to real estate. Christopher Owens saying how poorly REITs did yesterday and other indicators he uses. You know, you read in New York City, you read every Bloomberg and Crane's article that's out there about each real estate transaction. It's ugly.
It's ugly. At the same time, it's not that ugly, right? I mean, that's the thing, is that people are looking for it to be the catalyst to Armageddon, and it's not. I mean, we're used to the perma crisis that you were talking about with the likes of Mohamed El-Erian earlier this week, and we're looking at a market that doesn't have that kind of catalyst. So that's the reason why people don't know what's going to stop the sell-off in bonds that is causing yields to go to the highest since 2007.
A longer data check this morning in this 8 o'clock hour. John, I'm going to start with a bank rate 30-year mortgage breaching 7.75% out to 7.78. How close is that to 800?
Amazing. Just around the corner, Tom, off the back of these moves in the bond market. 30-year, 465, 10-year, 450, 2-year, still north of 5%. Off the back of all of that, dollar strength. The euro breaking down to 105.40. Dollar yen breaking out to 149.20, 149.25 session highs. TK getting closer and closer to 150. That is a weaker yen, a weaker euro, and a much stronger dollar.
Even Mexican peso giving way here. It's been so strong for so many weeks. 17.59 Mexican pesos per dollar. On your equity markets, on your new 201k with a VIX at 18.26. Nadia Lovell, Senior U.S. Equity Strategist, UBS. Nadia, thank you so much for joining. Give me the siren call of whatever the new level of cash is going to be, 5.25, 5.55. Someday it's going to be a level like 6% cash. Do I need to be in cash?
No, I don't think that you need to be in cash. I think that there are opportunities in the market, equities as well as the bond market. We think that there is some upside to this market. I mean, this welcome pullback, I think, is very healthy, and I think that it's time to really start to leg into the equity markets. And in the fixed income market, even though yields have backed up a bit, we do think that yields will trend lower in the coming months. We do think that the economy will start to slow, and the Fed is done hiking, and that should give some relief to bond yields. And so we will be looking to add to bonds as well.
Starting to leg into stocks. Which stocks, Nadia? Are you looking at consumer discretionary and saying, let's go?
No, we actually, in terms of, we're neutral consumer discretionary. We maintain a preference for industrial consumer staples and the energy sector. We know that energy has done quite well over the last few months since we upgraded it 3 months ago, but it has lagged the commodity, and we continue to believe that oil prices are sustainable in this $90 to $100 range. We're looking for 95 into 2024, and so we do think that there's a little bit more to go in the long energy trade. I mean, we particularly like the E&P companies and the oil services companies within energy.
When you talk about yields eventually going down, there's a question of what's going to trigger that at a time where people are seeing strength that was unexpected in the economy. And they're saying that it will cause inflation to stay higher for longer, the Fed to stay on hold for longer. What gives you confidence that both equities can keep doing well and we are going to get yields going lower, typically some sort of symbol of weakness being expressed to the market?
Yeah, we are looking for more sub-trend economic growth, but we aren't calling for a recession. And so we think that you're going to be in this sweet spot where the GDP growth is probably around 1%. The Fed is done hiking. We know that historically when the Fed is done hiking, bond yields start to fall. I mean, we think that inflation is going to continue to remain on this downward trend. I mean, for core PCE on Friday, we're looking for about 14 basis points. And when you annualize like the last 3 months in core PCE, you're at 2.3%. Right. And so we think that inflation is going to cause the Fed to stop hiking and look to ease rates in 2024. And so that should be supportive to the equity markets as well as the bond markets.
Nadia, I'm going to editorialize and suggest that maybe the bond market on price is in a bond bear market, price down and staying down and looking for new lows. In the equity space, I'm confused. Are we in a bull market off the October lows, or are we reaffirming the bear market reality in stocks?
No, I don't think that you're going to re-enter a bear market in equities. I mean, reality is the earnings recession, in our view, is behind us, and so we think the upcoming earnings season, of course, will be important. But we also think that you should be starting to see an inflection point in earnings after 3 quarters of negative earnings growth. I mean, when we look into 2024, we see high single-digit earnings growth, really supported by still a growing economy, and still a consumer. Yes, the consumer is pulling back, but the consumer is still there. So, I mean, when we look into 24, we're looking for 4,700 on the S&P 500. So no, not an indication of a retest of the bear market.
What do you do with tech and other high flyers? I'm thinking luxury, which has been beleaguered, I guess. But what do you do with those leading sectors from before?
You were seeing a pullback in tech. We are neutral tech, but we think that this pullback could provide some opportunities. What's really going to be important for tech, again, is the earnings season. This is really where the rubber is going to hit the road. No longer is just the utter of the term AI is going to move a stock. You really need to start to see revenues come through on that, or concrete plans around AI. And we do think that you are going to start to see some growth in some of those areas of tech that had been weak or signs of bottom and stabilization, whether that be PC, smartphone, or cloud computing. And so for globally, we continue to like the areas of tech that are profitable, number one, and two, areas of tech where there are high percentage of recurring revenues and have some secular exposure to secular trends like AI and cybersecurity. We do think that there's a role for tech in the portfolio.
Nadia, we talk about these macro trends, and then we get these micro stories like what the FTC did yesterday with Amazon. How much and how do you sort of view those headlines and translate them into overall theses? How much do you care about those type of developments?
It's important to keep an eye on these things because obviously, these sort of cases could eventually lead to a breakup of a company, which in some view, even some of the breakup of these larger companies can unlock value. So it is something bear watching over the longer term. But I think in the nearer term, what's going to matter more is really the earnings growth, what the Fed is doing and what the economy is doing, not so much in terms of a regulatory standpoint, because these regulations take a long time to play out, and most of the time they end up being nothing.
It's Groundhog Day once again for Amazon. Nadia, thank you. Nadia Lovell of UBS Global Wealth Management. Lisa, we touched on that, didn't we? How many times have we talked about this story regarding this company?
So, do you think that it was something else driving stocks lower, driving Amazon stock 4% lower yesterday in the day, right? I mean, because you raise a point, and I actually expected there to be very little price action because we've seen this again and again and again, and nothing has come of this. There's something else going on.
If I had no access to any news whatsoever and just eyeballed this market, I'd be like bond market. Treasuries.
Exactly. So I think that people are looking at some of these peripheral ideas of FTC suits and maybe using that as an excuse to sell because of bond yields where they are.
The wall of worry.
Yeah.
The wall of worry, just another brick in it.
Exactly.
Someone just crashing right into it at the moment and not climbing it.
The wall of worry's out there, and it's going to be news flow, and data dependency becomes ever more crucial. And, I see also Dan Niles just out on Twitter. Great respect for him. He's been shorting. He just covered his short supposedly out on Twitter. There's going to be a lot of courage displayed with some people right, some people wrong.
The courage to buy this bond market as well, offering up 450 on a 10-year, which is amazing to see. Amazing. If you're just tuning in, welcome to the program. Your equity market positive here by 0.3%. Yields are a little bit lower by 3 basis points. The 10-year 450.51. Steve Rasciuto of Mizuho is going to join us in about 18 minutes or so.
Perfect.
What will change it? What will drive ultimately demand for the Treasury market? At least you'd have to imagine weak data, bad economic data, which is what some people are anticipating later this year. The problem is, and I've said this a million times this year, it's the economists who cried recession.
Exactly.
We've sat here so many times and talked about it, and now they're still saying, yeah, but this is it. This is it really. 4Q tension headwinds for the U.S. consumer.
TD Securities just put this out, their rate strategist, saying the beatings will continue until morale deteriorates. And that kind of is what this feels like, right? That essentially you're going to keep getting it wrong until finally people start suffering a little bit more, because essentially that's been the story of the calling recession that just hasn't happened.
Starting to see in consumer discretionary stocks. It's been painful for that part of the equity market. Chris Verona Strategas was with us a little bit earlier this morning. We had that conversation with him. How do you frame this moment? Do you see this bond market move as a reflection of the extension of the cycle, reflection of the resilience in this economy, or a recipe to end it, a recipe to drive in some pain into this economy? And he said, based on the move in discretionary, Tom, it's the latter and not the former.
I think that's one of the theories that's out there. Having Steve Rasciuto come up with his work with Dominic Constant at Mizuho is going to be able to frame where we are. But again, I'm going to go to the data, and the first thing is to get to the weekend. I mean, to be honest,
that feels like somewhere away still.
And again, what am I watching most, folks? I'm watching real estate. I think that's a huge story here.
This is where we are right now. The dollar, the strongest it has been throughout the whole of 2023, and crude at highs for the year as well. 95 on Brent. That conversation with Amrita Sen, energy aspects on why she's looking for triple digits.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We think it probably normalized towards $100. The question we've had a lot today is why 100? Well, when you look at spare capacity of OPEC, over the next few years, the only ones that are going to be able to fill that gap in supply is OPEC. And historically, when spare capacity has fallen to sort of between 5 and 10% of total capacity in the world, that's a risk premium, which I haven't used that term for a very long time in the world, maybe last year briefly, that will drive $20 above the 80 to 100.
Looking for triple-digit crude, Christian Malik there, the global head of energy strategy at JP Morgan Securities. We've heard a lot about that number over the last week. And Rita Sen of Energy Aspects calling for $100 oil by Halloween, the last time she was on Bloomberg surveillance. In her latest note, she says this: we do not see prices letting up in the near term. Crude fundamentals have become strong enough that the macro story is no longer sufficient to drive price action. Tom, instead, crude is starting to drive the macro view.
Joining us now in New York, as usual in London, Amrita Sen, co-founder, head of research, Energy Aspects. How does Saudi Arabia react to the bond turmoil and critically strong dollar currency turmoil worldwide in OPEC Plus and outside OPEC Plus?
I think, Tom, that's one of the biggest reasons why Prince Abdulaziz has insisted on keeping these cuts. He is extremely worried about what he's seeing in the macro market, right? Bond markets are reflecting this uncertainty. What does it mean for growth? And why preempt that by bringing barrels on, for instance, and you get a big slowdown in growth, only for them to have to cut it back?
What was the mood like in Oklahoma City? That's where you just came from with this conference. David Solomon, interestingly, was there of Goldman Sachs saying, we support you, which is a real change in the tone of some of the biggest financial institutions in the U.S. Was the tone optimistic that you could start investing again in a way that was more meaningful with the idea of higher oil prices?
No, I think it's a great question. And I think the mood was optimistic because oil prices are at 90. But I do think there was a sense of pessimism as well, because the markets aren't really allowing CEOs and companies to invest, shareholder pressure, and governments as well around the world. I think you're starting to see some European governments backtrack over the last couple of days with some of their big targets. But in general, I'd say, the support from the Western governments for oil and gas companies remains very limited, with the focus still mostly on ESG and renewables.
Well, there's a larger question here than how high prices could go. And the Continental CEO said that oil could hit $150 without government backing. Do you agree? I mean, honestly, when I saw that, I was like, of course. But that's just my natural internal skepticism. What's your take?
I mean, look, those numbers, they're just a number, right? Like you can't kind of like, what's the difference between, I don't know, 130, 150, 200? I wouldn't sit here and call for those numbers, but I think the point I would make is, and we've been calling for high prices for the end of the year consistently, and we were very out of consensus. But my kind of fear in this market is we have destocked so much inventory. Right now, what's going on in the US, Cushing is dry. And even when Cushing has fallen to record low levels, it can't keep barrels because the rest of the US is so low that it's continuing to pull barrels from Cushing. Dubai, I don't know if you saw this morning, Dubai spreads have gone to over $3 backwardation. It's telling you this market is very, very tight. And we are not seeing signs of investment from companies, not because the CEO doesn't want to, it's because we in the world, society, governments, they're not allowing them to. We do continue to see a huge supply gap in the medium term, probably around 27 or 26 to 29. We don't have enough projects in the pipeline, and that's where OPEC and Saudi Arabia and UAE have to step up, and that's where the projects are coming through.
This is ultimately the point that you're making, that perhaps some people are getting this back to front. You're saying that the macro isn't driving crude, crude's going to drive the macro. Can you explain that just a little bit more?
You know, the first half of the year, we had every Fed decision mattered more to crude oil than OPEC decision, right? Whereas now, you've seen even when in the bond market, the turmoil we've seen equities come off, but crude's really held up. And that's purely driven by fundamentals. And the worry now is if crude markets are this tight, you start getting oil prices going up, and then does that influence Fed decision again through inflation?
In your experience, how inelastic is demand for certain crude products? How much demand destruction could we see off the back of these prices?
Oh my God, Tom's going to love this, because I'm going to say this because I have started to see this not just in China, but even other parts of the world. It's very early days, so Tom, don't ask me to put a number to this elasticity thing I'm going to mention, but I'm sensing that oil is becoming more inelastic. With, like, if you look at this, the global economy this year is going to be less than 3% GDP growth, right? But oil demand growth is going to be more than 2 million barrels per day. Now, China, we know, still post-COVID recovery, but there's something around, initially we all thought working from home will lead to lower oil demand. It seems to be going the other way, because now people are having to come into work. There's more driving from further away because people have still moved out during the pandemic. We just aren't seeing the same impact from higher prices on demand. Again, early days, maybe people have excess savings. Let's see what happens next year, but I'm keeping an eye out on that.
You want to put a number on that?
I'm telling my group of economists to continue to do that.
The microeconomist Jeff Curry at Goldman Sachs, exiting, made very clear to us that the tangible real yields globally, the end of the free money that we've seen, changes your world, changes oil investment. Are you beginning to see indications that a 10-year 2.22% real yield changes how oil animals think?
Absolutely, and I think we've been talking about this since April, really, Tom, and that is my worry. Nobody wants to hold inventory just for basic kind of, we always used to say we need X number of days of forward cover, 15, 20, whatever that number is. You need that buffer. What if a cargo gets delayed? What if there's a Libya happening? Today, because of the rising rates, it's too expensive. And that's what creates the risk of volatility and upside for prices going forward.
So let's reaffirm the price. John started with that. I mean, you made some real headlines and vision of $100 a barrel at 95.57 Brent crude. We're really buttressed right up against the 96 level. But before, get us out beyond that to the fear of 120 a barrel. How do we get there?
I think Those kind of those kind of numbers, you probably need an event, right? A supply shock. But in the day-to-day trading, if we break these technical levels, of course we can make a run up to $100. Like I said to you last time, calling 100 at 95 is not a big call, right? So I'm not going to do that.
But to get to the new regime.
No, the new regime. I do think, yes, and one of the things to bear in mind, there's crude and cracks. Diesel cracks, yes, they're coming off, but gasoline and diesel cracks are on top of that. So that's where I do think, in some ways, you have to put a risk premium to prices because you don't have enough inventories. Once you break through this next level, we can then go into that paradigm where we just hang around $100 unless there is a clear sign that demand is slowing down. We haven't seen that yet.
Just to finish, how sustainable do you think the Saudis' current position is?
Oh, it's very sustainable. They're very, very clear that we want to make sure inventories are not building. And I think there's clearly signs of that. And also the macro concerns, right? And that's where it becomes a bit of a chicken and egg, because we've started to get worse data from the US. That's going to concern them even more. And that almost makes them more cautious in adding barrels back.
The reason I ask is because there is a monthly review. I'm just wondering whether I should ignore the monthly review between now and the end of the year.
I mean, we have seen Prince Abdulaziz and even Alexander Novak come and extend the cuts to year end. Of course, they always keep an eye out on the market. We've got the November OPEC meeting as well in Vienna. So there are a few things to kind of consider before year end. But, you know, that deal is still, I mean, he's extended it for a reason. He is concerned about the global economy. I'm not going to change that overnight.
We'll see if they let us attend that OPEC plus meeting in Vienna. You don't want to weigh in on that. Don't worry about that. Amrita Sen of Energy Aspects. Amrita, thank you. TK, triple-digit crude is only $4 and about 50 cents away.
It's an international event, and the International Bank in America, at least the romance of it, is Citigroup. Thank you to Barchat. It's a great Twitter handle. They do a lot of smart stuff. And Barchat's got out this morning. I miss this, folks. We miss a lot here because there's just so much to watch. The House of Jane Fraser, reverse 10-to-1 split, is in the vicinity of $3.99 per share. We're not there yet. We got down to $4.01 per share.
We have this conversation every time. Is that bar chat or bar chart?
I thought it was bar chat.
Is it bar chat or bar chat? Do you want to double check?
It's very valuable.
Just in case someone wants to go and access that material out on X, the platform formerly known as Twitter. Amrita, thank you.
Just Amrita wanted me to put a number on it.
I know. Coming up on the Open next hour, Tony DeSpirito of BlackRock, Tony Dwyer of Canaccord Genuity, and the brilliant Amy Wu Silverman of RBC. As we count you down to the opening bell, about 1 hour and 4 minutes away in a couple of seconds, your equity market higher, positive by 0.3%, trying to bounce back from 3-month lows. From New York, this is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance on radio and television. Jonathan Farrow on assignment. Lisa Bramwitz and Tom Keene here with markets. We've been doing durable data checks all morning, Lisa. It's a durable bond market as it tries to find a durable price south.
Tries to find a durable data point to try to give some direction, and we do get durable goods in just seconds. It is important to say, and you've been on top of this, Tom, that the dollar strength is really the one move that has permeated and continued from day to day, and it continues yet again today.
With a durable report on durable goods, Michael McKee. Michael McKee, why do durable goods matter?
That's a durable question, Tom. Gets asked a lot. The headline numbers don't matter as much as the capital goods orders non-defense ex-air. So why don't we start there? Up 0.9% after a 1/10 gain the prior month, which is a bit of a surprise. We'll have to see if that is revised at all. But I'll tell you what, the capital goods orders non-defense is good news. Yeah, it was revised down to a -4. So you get over the past 2 months, you've got a swing of 0.5 percentage point. Durable goods orders overall up 0.2% after falling 5.6%. That's a revision down by about 0.4. Ex-transportation up 4. We expected, the headline was expected to fall more because ex-transportation take out the Boeing numbers is what you always have to do. And at this point, it looks like that didn't matter all that much. Shipments up 0.7%. I heard you and Steve talking about third quarter GDP during the break, and that'll feed into that. These are August numbers for third quarter, and shipments obviously stronger than had been anticipated. So it looks at this point like reasonably good news. Now, cherish these numbers, because we get tomorrow and Friday, and then we may have to go a very long time without data. So be very excited out there.
Michael McKee, on sabbatical if we get a shutdown. Of course, he's leading our coverage here on shutdown, surveillance shutdown central. We'll have more on that. And look for balance of power as well this evening to give you an update on what's going on in Washington. Lisa, just very quickly here. Michael McKee, thank you. Just, Lisa, a little bit of market move. I don't really know what to make of it. Can you?
You saw 2-year yields slightly inflect upward, but this isn't going to make the break or make or break the bank. The idea that the headline number came in better than expected, yet another better than expected data print, keeps people on edge. That is the economic surprise, continuing to the upside rather than the Bob Michael view of the world of the deterioration continuing and really deepening.
We'll drift away from the markets. Brent crude 95.36 up $1.40, really buttressed up against 96 an hour ago. And the interesting strong dollar features. We'll sum all that together, and we can do that with Stephen Risciuto. He's chief U.S. economist at Mizuho Securities. The Risciuto-Constant tandem is extraordinary what they've got at Mizuho right now. Let's go to third quarter GDP. I believe it ends in 3 days, if Taylor Swift allows it to. And the answer is you are more optimistic than many. State the optimism.
Yeah, I mean, I think the reality is the consumer began the quarter on a very, very strong note, and we have seen it tail off as the quarter goes on. But you're considering quarterly average data, so raising the early part of the quarter and the end of the previous quarter sets a higher base for the quarter in general. Then you've got information like you got this morning in terms of the durable goods shipments, and then you can look at the investment expenditure components. And even though there has been some weakness in housing, the actual level of construction started in housing is there, and we had a little bit of a reduction in the trade component. So I think when you add it all up, the surprise in the GDP number is actually a much more healthy number than people think, more in lines with the Atlanta Fed numbers than the New York Fed numbers.
So how do you understand this, right? We have the idea of people saying that they feel very uncomfortable, that inflation is impeding their ability to spend money in other places, and yet home prices went up. We hear that people are less confident than they've been in more than 6 months, and yet suddenly we're seeing consumer spending remain robust. How do you pair what people are saying and what people are doing?
There's a disconnect, and there often is a disconnect between what people say and what people do. Yeah, I'm concerned, but I'm more concerned about where it's going to be in the future. But, you know, I really feel like getting this done, and I'm employed. I feel comfortable in my job. You know, UPS workers are making a heck of a lot of money. UAW workers want a 40% wage increase. I'm going to get paid more. I've got a good job. Nobody can fire me. I'm just going to go out and spend money. And oh, by the way, right now, shadow banks are willing to lend to them. So the net result is they're going out and actually spending the money.
Are they going to get the wage increases? Because we see that the strike activity is continuing and accelerating on some level. We've seen, yes, some sort of maybe resolution with the Writers Guild over in Hollywood. UAW is still ongoing with the support of President Biden. You have now the Las Vegas bartenders and other and housekeepers and food servers coming out authorizing a strike in that region. Is this going to push wages higher regardless of how much the GDP hangs in there?
Well, the reality is there is a real wage pressure problem. And even though there's a smaller percentage of the economy is unionized now than back last time we had a significant wage-related issue in the economy, the fact that we have 24-hour-a-day, 7 days a week, 365-day-a-year financial press, and they're looking for things to talk about, and this wage story is a big thing, everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
The idea of Risciuto and Constant down the same hall or wing of Mizuho, New York City, is extraordinary. Dominic Constant has been screaming in a wonderful way that this Fed is, quote, super restrictive. I see it in the Bloomberg Financial Conditions Index, where finally the accommodation of the last 90 days is coming in. Overnight, the BFCI dipped below zero just for a cup of hot brown water? Yeah. Hot brown water. Flattering. It's come back up, but essentially we're becoming more restrictive. How restrictive are we now within the Risciuto constant restriction?
Well, the question is not how restrictive we are. The question really is how restrictive do we need to be to get the macroeconomic result we're looking for? And this becomes the problem. If you look at the different portions of the curve, the long end of the curve up until very recently had been very well controlled. Yes, mortgage rates were high, but corporate financing costs were good. Spreads are very, very tight. Then you look at the belly of the curve where securitization takes place, where the shadow banking industry funds, and it was, 100 basis points through what we're looking at because everyone expected 100 basis points worth of cuts. Now we've taken out 50. I hate to tell you, we're going to take another 50 basis points out. So the reality is the restriction that we have in terms of the Fed funds rate is not necessarily the restriction that's being transmitted to the rest of the economy. And that's been the problem for the economy and for the Fed.
So critically, how does Chairman Powell adapt to that, to the Risciuto constant restriction? Well, how does he adjust?
The problem for the chairman is the other members of the committee continuously torpedo the ideas that are laid out in terms of the FOMC.
But he's the chairman.
It doesn't matter. His vote is only one, and he's reflecting the committee in general. He's one vote on that committee.
Oh, come on, Greenspan didn't run it that way.
Greenspan was a very, very different chairman. Greenspan's vote counted more than anybody else's. This particular chairman doesn't have that clout. And the net result is you have a situation where the political economists versus the academic economists are winning.
bronze that. Folks, it's September 27th. That's the most important comment I've heard on Bloomberg surveillance in 2023.
I want to go back to the idea of wage pressures, Steve. You were basically saying that it's the media's fault because we're looking for things to talk about. So we're talking about all the strikes and that it's leading to people asking for higher wages. Companies will not pay them unless they can afford it without going out of business. Are these wage increases sustainable with the business models as they are?
Well, again, I'm not blaming the press. I'm just saying that's part of the dynamic that you have to take on board. That's number one.
I just had to call you out.
Yeah, that's okay. Number two, you have to realize that the benefit for companies is so far, up until very recently, the equity market's been giving them a pass. Okay, in the first 9 months of the year, operating earnings are down. Yet the economy has been above growth potential and inflation's been high. Yet the market is assuming we're going to have 12% rise in earnings next year. Here again is a disconnect. The numbers don't add up. If this year you can't get positive earnings growth at all so far, how are we going to get 12% earnings growth next year? So the reality is, as the equity market comes down, companies are going to be forced to say, I got to increase my margins. I'm going to go out and start shedding some of my workers. And that's when you start to see the consumer come down. And that's where the risk becomes of a 2024 recession. Not until the equity market starts telling CEOs, you have to do something about your margins. And it's just beginning to happen.
This is a really fascinating point because a lot of people are looking to why is the stock market so optimistic? Is this sustainable? And you're saying that is what has to give. The margins, because these workers are going to get those wages and then the layoffs begin. So if we don't see them until next year, until later in the year, how high do benchmark rates go? How much could this Fed overshoot it, in your view, to get it down to 2%?
Again, the reality is the terminal rate is a moving target. It's up to be honest, granted, it's up to two things. It's up to how quickly the long end of the curve stresses the Fed, because the Fed is willing to play games, or at least some of them are, with the idea of a 2% target. You heard Goolsbee the other day, okay? Those are fine examples of the problem. So when the chairman says, I'm adamant on a 2% target, and Kashkari comes out and says, I'm adamant on a 2% target, there are other members of the committee that come out and say, you know what, when we get to 2%, we'll rethink it. Well, no one's going to believe 2%. So the reality is long-term rates are moving higher. As long-term rates move higher, inflation expectations become unanchored. Then the Fed has to address the situation. If inflation expectations become unanchored, what do we do? Do we allow it to happen and sustain a higher inflation rate embedded in the system, or do we take action against it? I think they'll eventually take action against it.
You're so fired up. We're going to continue with here. We got to do a data check right now because the markets are moving on radio and television. Good morning across America. Lisa, it's green on the screen. The equity market says everything's fine.
Well, but this is really the issue, is that something has to break it. And to your point, if the Fed is really truly committed to that 2% goal and is concerned about how unmoored inflation expectations are, what more can they do, right?
There's only one thing they can do, and raise interest rates. You saw that last year when inflation expectations began to become unanchored, and Bullard came out, who unfortunately is no longer there. Bullard came out and said, hey, we got to go 75 basis points, and they went 75 basis points in 3 steps. And the net result was inflation expectations became anchored again for an extended period of time, and the equity market managed to do better. This time through, it's questionable with the new composition of the committee whether or not the committee will make those same steps. And the market, I think, is building in an inflation risk premium. People like to call it a term premium. Actually, a term premium is nothing more than an inflation risk premium. And the market's building in an inflation risk premium because they say there's a 2% target, but is it really a 2% target? I'm no longer believing them.
We're going to come back on this. Steve Raschuto of Mizzou with us right now. You need a data check. Futures up 16, the VIX 18.30, showing some of the tension there. But in the bond market, disinversion continues with negative 56 basis points, 2.22% in a little bit, but a stunning 2.18% on the 10-year real yield. I've got the dollar stronger. Dollar out to DXY strength about 40 minutes ago. We'll monitor that through the day. The Standard & Poor's 500, green on the screen, up 0.4%.
I want to pick up there on what Steve Raschuto was talking about, Tom. I mean, this idea that the risk premium, that the term premium is no different than the inflation premium, that basically people are not believing the Federal Reserve really is committed to getting back down to 2%. Stephen, is that a worry for you? Economically, does that actually create a risk for the economy that people are underappreciating?
Well, I think it certainly creates a risk for long-term investors. You know, when we were in the 3.75 to 4.25% trading area, we were basically priced at perfection for a 2% target. You know, 1.75 to 2.25% trend growth, 2% inflation. You're right there, 3.75 to 4.25. If you're going to say 3% is the target now, then I'm talking 4.75 to 5.25. It's a long way from where we are today. And that then becomes the issue. The issue first is for the markets. And then we can talk about what the issues would then be for the macroeconomic environment. Clearly, mortgage investors or household people who want to buy homes aren't going to appreciate the fact that long-term interest rates are going that high. But again, this is the risk the Fed takes by wanting to change the inflation target. And if you change the inflation target, I'm afraid your credibility disappears.
What is, for America, what does a 2% plus real yield mean? A huge body of people have never experienced this. What's it mean day to day?
Well, I mean, I think the question is a 2% real yield enough? I'm not sure it's enough. Go back to what you and I lived through in the Paul Volcker days. All right, where did Paul have to stop?
Big number.
Paul stopped at 26% Fed funds rates.
Yeah.
I'm not saying when you get there, it's a different world, but be careful in picking a terminal rate.
We got to get you and Dominic on set together. That would be. Are you guys on speaking terms?
Yes, we are.
Okay, Steve, there's your break exclusive for the day. Rishudo Constam on speaking terms at Mizuho Securities. We'll get them on here together. Coming up, David Rubenstein, the Carlyle Group.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of Hello World, I head to Los Angeles. Meet some robots. Then eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
First of all, I think it's nuts to make a big issue of this debt limit thing. And because that's says simply it's a stupid rule we have in America that Congress has to approve twice, paying for something they've already voted to spend on. I mean, a lot of these people who were opposing raising the debt ceiling voted for most of the debt that is embedded there.
He is 77 years old, the former president of the United States, Mr. Clinton of Arkansas at the 92nd Street Y. That with David Rubenstein and Secretary Clinton as well, Hillary Clinton, Bill and Hillary Clinton on Bloomberg Tonight together at 9 p.m. So you'd think you'd show up, Lisa, and it'd be like Pelsy-Welsy, happy, happy. The material of this interview with David Rubenstein is stunning.
Especially at a time where there are real questions about what a changing of the guard in Washington, D.C. on both sides of the aisle would look like.
I can't say enough about this, folks. Whatever your political persuasion, Mr. Rubenstein has hit a home run here on the controversies deeply embedded across America. He's co-founder, co-chairman of the Carlyle Group. David Rubenstein joins us this morning. David, I got 8 ways to go here, but I've got to go to the idea that the former president of the United States thinks the Electoral College of Madison, Jefferson, and the rest is out of date. Is he serious?
Well, he favors direct election. Obviously, direct election has some problems, but as he points out, the Electoral College was set up when we had 13 states or colonies, and it was set up in a way that was designed to help the South have more influence in the election of the president because of the slavery issue. But in the end, direct election has been talked about many times over the last 200 plus years, and I think it's unlikely we're going to change because it will require a constitutional amendment which requires 2/3 of each house and 3/4 of each of the states, and the smaller states are not going to agree to a direct election system which eliminates their influence in the Electoral College. But I think the most important thing I would take away from the interview is that Bill and Hillary are still very deeply involved in what's going on in the United States. I think no couple since Eleanor and Franklin Roosevelt have together had as much influence for as long a time as the Clintons have had. Bill Clinton was president of the United States for 8 years, Hillary Clinton a senator for more than one term, and then Secretary of State for 4 years. And so the combined experience the two of them have is quite unusual. Eleanor Roosevelt never held elective office. And interestingly, I think they still have a lot of influence in the Democratic Party. When they talk, people do listen. And I think they're widely regarded as having pretty good political insights and pretty good policy chops. I don't think that today, they are likely to be able to influence President Biden that much, though they know him. But President Biden is on a certain trajectory. But there's no doubt that they have influence throughout the Democratic Party and probably with some influence with President Biden.
There's a really intense debate right now, David, among a lot of people talking about the age of the candidates who are running for office and whether it represents the rank and file of the country, why it is that sort of mainstays in politics have continued to be the headliners again and again, year after year, even as some people would argue they may be aging out. What was the view of the Clintons on that?
Well, they're not going to say anything specifically about the age issue in a way that would be upsetting to President Biden. But there's no doubt that both of them are in their mid to late 70s now, and they recognize when you're in your mid to late 70s, I'm 74, you probably have more challenges doing certain things than you can do before. Last night in a different forum, I interviewed Jim Baker, former Secretary of State, who's now 93 and a half years old. And, you can see he's very smart still. But, when you're interviewing somebody in their 90s, it's different than interviewing somebody in their 60s. I think the President of the United States today is, 80, and his likely candidate against him, Donald Trump, is 77. So it's a different situation than people expected. When I was a younger John Kennedy ran, he was 43 years old. That was thought to be too young. What's too old, what's too young, nobody really knows. The voters have to make their decision. There's no doubt that as all of us age, we recognize that it's more difficult to do certain things in your 70s than you could probably do in your 60s.
No.
Well, it's a good point, and everyone's age is different for each person in terms of what they can do. It's just the reason why I bring it up is because it has played so heavily in polls at a time where people are trying to understand what the new path, the new vision is. Yesterday, we saw President Biden on the picket line talking about workers' rights, and a lot of this had to do with the globalization and some of what that did to the industrial complex. Do the Clintons weigh in on kind of how they see globalization at a time where it's really being called into question?
Well, I don't think they think globalization is going away before, but I think globalization, they would say, and I would agree, is here to stay. It's just going to go through some ups and downs. Clearly, the Congress of the United States is more divided on globalization than it was when President Clinton was in office. When President Clinton was in office, we brought the Chinese into the WTO, and now there's some people that think that was a mistake. I think it was a good thing to do, but there are many people who think that we've given China too many opportunities to be competitive with us. And, you know, I think the Clintons are not against China's being in the WTO for sure, but there's no doubt it's a different environment than it was 25, 30 years ago.
What will the impact of the Clintons be at a convention in 2024, or the development of, I guess, Mr. Biden running again? What do you perceive as being their impact on the party?
Their impact is that they're highly, highly respected. I was at an event in Aspen this weekend where many people who are prominent former leaders of the Democratic Party were there. There were also Republicans there. And Hillary Clinton was a speaker, and she got a terrific reaction from many people there. Barack Obama was there. He also was well received. So I suspect at the next Democratic convention, Bill and Hillary, assuming they speak, will get standing ovations because they're very good speakers and widely regarded and highly regarded in the Democratic Party. Barack Obama and Michelle Obama the same. That's different to say that they can change people's votes that much. They have some influence, but as we all know, Bill Clinton is a very good speaker and very good at explaining things, and I suspect he'll get an incredible ovation when he speaks at the Democratic convention, as I assume he will.
David, he is dead at 86 years old. I know the impact that Brooks Robinson had on me and all of us is he invented third base for modern baseball. You were a lad in Baltimore at the time of that Orioles ascendancy. What did those Orioles teams and what did Brooks Robinson mean to Baltimore then?
Well, for people who grew up in Baltimore, Baltimore was always much smaller than New York or Philadelphia, or not less significant in some ways than Washington. So having the Orioles win the World Series gave us an enormous amount of pride, and Brooks Robinson was seen as the ultimate Oriole. He played for the Orioles his entire career, Hall of Famer, the greatest defensive third baseman in history. He's had some health problems in recent years and sadly passed away yesterday. But I think there's nobody who represents the Baltimore Orioles better or represented them better than Brooks Robinson, though they had many great players over the years. He was equivalent to Johnny Unitas, who was the star of the Baltimore Colts in that era. It's a sad thing to see that happen. You know, when you're younger, you look up to people like Brooks Robinson, and I did. I was very young, and he was just the ultimate baseball player.
David, thank you so much. David Rubenstein and the Clintons. Look for that, of course, here tonight at 9 p.m. on Bloomberg. I can't say enough about some of the comments that I've seen from this interview. Lisa, it's just amazing to see what the path is going to be to two conventions next summer, and then somehow out of Labor Day, we stagger through September and October next year. I can't frame what that will look like.
I can't even frame what debate's going to be most important. Is it going to be inflation? Is it going to be workers and unionization and getting wage increases? Is it going to be abortion? Is it going to be the question of, just globalization and international participation? No, but at the same time, if you take a look at all the different issues that have played, it's unclear which is going to be the dominant one.
I mean, I'm going to go back to the culture wars as identified, but really what this is about, and it speaks to a gentleman with a megaphone on a picket line at Michigan Truck that we saw in the last 24 hours. They got to get out the vote. They got to get out the independent vote. They've got to, both Republicans and Democrats, get out a youth vote of a changing America. And it's just, to me, there's a huge uncertainty of the path that we're going to see into next year.
And we'll be tracking it. Today there is a Republican debate that no one's talking about, but we will be talking about it tomorrow, I'm sure. There also will be the former President Trump in Michigan.
Will watch it. John Farrell will watch the debate tonight to report to you. These are Markets on the Move on radio and television through the day. More data checks. This is Bloomberg.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From the world of politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Horderg.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Live from New York City this morning. Good morning, good morning. 3-month lows on the equity market and trying to bounce. Your S&P 500 up 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, surging bond yields shaping up global markets. President Biden joining striking auto workers as Congress struggles to keep the government open. We begin with the big issue, consumer confidence taking hits.
We're starting to see the consumer certainly under some pressure.
Weakness in the consumer.
Consumers are going to be facing some headwinds here.
The market doesn't like the strong economy keeping interest rates higher for longer.
Even, 50 basis points higher from here really will start to impact the consumer.
Consumers continue to complain about inflation being elevated.
Higher oil prices.
They're still concerned about the labor market and their personal finances ahead.
The trend in yields is up.
Yields are rising.
You have to ask the question, is this last move up in yields the signal that we're end of cycle?
You always have that kind of last kind of move where people throw in the towel, and I think that's what we're going through.
I think from here, the consumer slows.
There's a real spending issue coming up, and I think that that's going to impact earnings.
Bond yields being higher, our Fed that's higher for longer, is going to continuously put pressure on just the broader markets.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Consumers are getting it right and saying, look, there's trouble ahead.
Let's build on that conversation. Joining us now is Canaccord's Tony Dwyer, BlackRock's Tony DeSpirito. I'll be using full names for the next 20 minutes. Don't worry, gents. Tony Dwyer, first to you. Let's talk about that consumer. Do you see this bond market move as a reflection of unexpected resilience of the consumer, or are they ultimately going to be a source of fragility?
I don't think it has very much to do with that at all. I think we're trying to make a great academic study, John, on whether it's inflation or economic growth. We lost our biggest buyers, right? Our 3 biggest buyers are the Fed, commercial banks, and foreign entities. So the peak day for the S&P 500, I believe, the peak moment was when Janet Yellen announced that she was going to, the Treasury Department was going to increase their issuance of treasuries to fund the government. That's when bond yields started moving higher. That was the peak day for the market. Now what's happened is you've got this incredible increase in supply because you went through the period of the debt ceiling debacle. So you have this incredible level of supply. The Fed is in quantitative tightening, so they're not buying. You've got China and Japan supporting their own currencies, so they're not really buying. And then the commercial banks are under regulatory scrutiny because of the Silicon Valley Bank issue. So when you lose your three biggest buyers and you increase the supply way more than expected, guess what it yields to, John? Higher yields.
You get some
and I don't
juicy
think it has
yields.
a lot to do at all with economic activity.
A 10-year at 450, a 30-year at 463, a 2-year at north of 5%. Tony DeSpirito, why buy stocks when I can buy that in the bond market?
Yeah, look, without a doubt, we're seeing more competition for flows from bonds. But I think, we've kind of been spoiled by, I'll call it the post-global financial crisis period, where equity returns post the GFC until the Fed started raising rates in 2021 was over 17% per year. That's more than double the historical average, and with less volatility. I think we're going to go back to the world before the global financial crisis, when we had kind of 8% returns. And so one of the things we do is we look at an equity risk premium. It's effectively comparing stocks versus bonds. And when you look at that ratio is like spot on, exactly in line with historical averages. So I think we've got to get that post-financial crisis period out of our mind and look back and say, you know what? Stocks versus bonds, much more like what we've seen historically. And of course, historically, equities have won, depending on the time horizon you use, 75% of the time versus bonds. So I still think equities for the long run for your portfolio. I do think we're going to need to be more selective because of more volatility and more stock price dispersion going forward.
And Tony DeSpirito, just to pick up on that point, are you basically saying we're going back to what you might call the old normal?
Exactly.
What do you think the relationship will be like with that in mind between equities and bonds? Because at the moment, bonds down, stocks down, and then all of a sudden bonds up, stocks up. Do you think we can break that and break back to that traditional, more intuitive relationship between stocks and bonds?
I do think we're going to go back to those more historic relationships. And I think also volatility. This is really important. Volatility and dispersion will increase going forward. I think that's both in terms of earnings volatility, as well as when I look at valuations, there's a wide dispersion in valuations. I look at that and say, look, two conclusions for investors. One is beta is not going to be enough, right? You're going to want more than stock market returns. You're going to want to seek alpha. And the environment is ripe for still skilled stock picking. And I use that word carefully, skilled stock picking. So if you can find a skilled stock picker, I think the alpha available from skilled stock pickers is going to be higher over the next 5, 10 years than it's been over the last 10.
Tony, do you agree with those two conclusions?
It's going to be a really difficult time, John. You're in the situation where somehow the Wall Street's thinking that you've got a historically levered system. Debt to GDP is at a generational high. And somehow we're going to have the fastest rate hike cycle in history. And it's all going to be okay, and we're going to have the Goldilocks. So our belief is that, believe it or not, when bad news becomes bad news, to the other Tony's point, that's when you want to look at taking advantage of the opportunity where the weakness has already been engaged. The average NYSE stock is now down literally 30.0% from its 52-week high. So, to believe that now the data is getting squishy, so you should become more negative because interest rates are higher, that's been in the restaurant stocks, the retail stocks, the bank stocks. It's been in all of those areas, and it's been kind of made invisible by the Fantastic Seven or whatever, phrase you want to use today. So our view is that you get three parts of this cycle, John. You get good news is bad news because it means a tighter Fed. That was 2022. Then you get bad news is good news because it means the Fed's done and rates can stabilize. But ultimately, the real time to buy, the time to be aggressive is when bad news becomes bad news. And I think we're starting to see the beginning of that with some of the consumer data. And God forbid we have a traditional credit cycle instead of a credit disaster. We've had, to Tony's point, 13 years of an incredible fixed income environment. and levering it up that way, just meaning the higher yields are going to have a bigger impact. It doesn't have to be a crisis. It's just a credit cycle, and that's what ends up in a recession.
You mentioned that economic data. Let's talk about it. Let's cross over to Mike McKee. Morning, Mike.
Morning, John. I wish I could help Tony Dwyer out, but unfortunately I've got good news, which is good news, and that's all I got this morning because durable goods is the only number out, and it does come in stronger than expected, in some ways more strong than even expected, because durable goods orders were expected to drop on Boeing, but they didn't. 0.2% gain, 0.4 ex-transportation. And the capital goods ex-defense, ex-aircraft up 0.9%. That's the proxy for business spending in GDP, so that's really good news. Capital goods shipments tell you kind of what went into the current quarter GDP, and that was up strong as well. We won't get those numbers until the end of October, if we get those numbers. Tomorrow we get GDP figures, but they're the third and final release for the second quarter, and we get jobless claims. Income and spending on Friday is going to be the last big number that we may get, as the Fed is looking at the PCE component of that. What is inflation doing? And are consumers still spending as they were? Michigan sentiment, you were talking about consumer confidence at the top of the hour. Conference Board was down some this past month, so we'll see if Michigan mirrors that. But then we're kind of out of business, because if the government shuts down, there's a lot of stuff that won't happen. I'm only going a week out at this point because we don't know how long it's going to last. But here's what you wouldn't get next week. You wouldn't get most or any of the government numbers. ISM manufacturing and services still out. That'll be important. Vehicle sales will tell us something, but really the numbers that the Fed's going to want to see are not going to be available. The problem only gets worse if the shutdown happens and goes on, but we're going to have to wait on that to see.
Mike, any conclusions on the damage it would inflict on this economy? That's the data we will and won't get. What about the damage it could do to the U.S. economy?
Well, it's not going to do great long-term macro damage. It will do damage in the short run, particularly to those people who aren't paid and have to call their credit card company and say, I'm not getting paid, so I can't pay you. And there will be some lost business. People won't go out to dinner, et cetera. But usually, well, the law says everybody who is furloughed gets paid when this is over. So what you'll see is a slight decline in GDP, maybe 0.2% a week, according to Bloomberg Economics, and then it all pretty much comes back once this is settled and people get paid. But there will be a little damage, not a whole lot. I guess the real question is, what does it do to Wall Street confidence?
True, true. Mike McKee, thank you, sir. Just lining things up for you, the potential that maybe we won't get some of those data points. Tony Dwyer, let's just build on some of the stuff that Mike was talking about. Let's make a list. Later this year, we could be seeing a government shutdown, student loan repayments. We've got crude back in the 90s, headwinds again for the consumer. You mentioned consumer discretionary. Given the moves we've seen recently, Tony Dwyer, is that a buy for you then?
No, it's not yet a buy until the only thing that will create a real significant, sustainable, fundamental buy that brings me back to the perma bull status, John, is when you get a real drop, not a one-time drop, but a real drop, not just in U.S. Treasuries yields, but also mortgage and corporate yields. The corporate yield for the high-yield debt yield towards my Bloomberg terminal, as of last night's close, is almost 9%. It's 8.86%. So companies don't really care about what the spread is. They care about what rate they're going to be able to get money at. And until the cost of that money comes down in the Treasury, mortgage, and corporate market, we're not going to get fundamentally bullish. And just one last thing, John, to Mike's point about the data, if you look at the revision in the prior months of the core durable goods data, you kind of shake your head and wonder why you look at any of this stuff. The way that they're collecting the data and the revisions that are taking place make it very difficult for a data-dependent Fed to be right.
True, true. And when I talk about consumer discretionary, I think it's worth pointing out the kind of names that are in that group, that bucket on the S&P 500. Massive range of names: cruise lines, Amazon, Tesla, Nike, Ford. Tony DeSpirito, with that in mind, do you like what you see, given the correction we've had so far?
Yeah, so I think one of the things to do is say, look, I'm not in the business of predicting a recession or not. What I'm in the business of doing is picking stocks. And so the way to go about this is say, what sectors or industries have already discounted a recession versus which ones haven't? And so I would call out banks and financials. On one hand, if you look at the way banks and industrials, if you look at the way banks are trading, low double-digit PEs, 10 times current earnings, low price to tangible book. They're discounting a recession. And then you look at industrials, I understand the recent strength in the data, but they're trading at multiples closer to 18, 20 times. they're both cyclical businesses. So I'll just go with the ones where the pain's already discounting, and therefore that creates a margin of safety. I think that's the stock picking strategy that you need to pursue in this kind of market.
Tony and Tony, stick with us. We'll keep building on this. Tony Dwyer, Tony DeSpirito. Your equity market right now on the S&P 500, still positive, trying to bounce by about 0.4% after an ugly, brutal day of losses again in yesterday's session. Let's get you some movers going into the open. Here's Abby.
Indeed, John, a bit of a relief rally, at least right now in the pre-market. Starting out with one stock that's not helping those shares of Costco. They are down, and this despite beating in the recent quarter, down 1.7%. Investors are concerned that the company did not talk about raising their membership fee. That's seen, according to Morgan Stanley, as a slight disappointment weighing on the stock. ExxonMobil up more than 1% with oil WTI crude back above $92 per barrel. Since June, this stock up nearly 20% with the crude oil rally, and clearly the best sector over that time period as well, as we've seen so much weakness for other sectors with yields higher. Coinbase Global, we have a bit of a rally for Bitcoin, John, up for the second time in just, I believe, 7 days, taking many of these stocks with it. It's an interesting barometer, of course, of risk on, risk off. If you recall, in 2021, the VIX was seen as broken, so people looked to Bitcoin today. A bit risk on for that.
Abby, thank you.
Barometer.
Abby, we'll catch up with you around the opening bell. Coming up, President Biden joining the picket line with striking auto workers.
The fact of the matter is that you guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices. Stick with it, because you deserve the significant raise you need and other benefits.
Team coverage down in Washington. Up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation? The fact of the matter is that you guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices, gave up a lot, and the companies were in trouble. But now they're doing incredibly well. And guess what? You should be doing incredibly well too. Stick with it, because you deserve the significant raise you need and other benefits.
Amazing to see President Biden joining the UAW picket line, endorsing the union's push for higher pay. This is Republican presidential candidate Donald Trump counter-programs tonight's GOP debate, visiting Detroit to speak at a non-union auto parts plant. His campaign saying he will deliver a primetime speech before current and former union members. Previously, Trump has pushed back against Biden's union agenda, saying, quote, Biden had no intention of going to visit the United Auto Workers until I announced I would be heading to Michigan. Tell him to leave the car industry alone. Your team coverage starts right now with Bloomberg's Anne-Marie. Katie Lyons down in Washington, D.C. AMH, quite a scene for the President of the United States.
It was quite a scene, and we should note the White House will say that the president is not only the most pro-labor union president we've seen in American history, but now he is proving it by showing up to that picket line, taking that megaphone, and saying, yes, you deserve the raise increases you're asking for, which, by the way, the union was asking for 40%. Now they've actually lessened that to 36%. But, Jonathan, what the White House will also tell you is that Sean Fain, the UAW president, invited President Biden, and that is why he is there. It is not that he is chasing Trump's tail there, and Trump will be there this evening. And the politics of all this has to go with the 2024 election. Michigan is crucial for the Democrats. Biden picked it up in 2020, but Trump flipped this state red. It was blue since the it was red. It hasn't been red since the late 1980s. And Jonathan, he won it by 10,704 votes. These are the voters that both these men are trying to take a hold of for next year.
They're the fine margins that you just talked about, AMH. Katie Lyons, where does this leave Donald Trump today?
Well, it leaves him wanting to, as Anne-Marie said, also address these people, these working class individuals, many of them who are auto workers. Now, as you pointed out, John, he isn't here at the invitation of the union, which is why he is speaking at a non-union shop this evening. Sean Fain, the president of the UAW, has pretty much openly expressed displeasure with Donald Trump. He said just recently he doesn't think Trump cares about the working class people. He thinks he cares about the billionaire class. And he goes on to say he's just trying to pander to people and say what they want to hear, and it's a shame. So there's a clear split between Trump and union leadership, even if he may be speaking to some union members this evening with this message that the EV push that President Biden has underway is hurting people working in the U.S. and shifting jobs overseas. All that said, as much as Trump is trying to address workers this evening, he also is trying to counter-program the second primary debate that is happening out in California this evening. That's where 7 other presidential candidates will be, probably having to address the elephant very much not in the room. What is interesting, though, John, is Asa Hutchinson, the former Arkansas governor who did not qualify for the second debate, is going to be counter-programming Trump's counter-programming. He's also going to be in Detroit this evening holding a press conference, and what his campaign says is he's going to be highlighting Trump's false promises to blue-collar and union workers in Michigan and across America. So there's going to be a lot of split screens this evening, John.
Fascinating 24 hours ahead. Katie Lyons, thank you. AMH to you as well, down in Washington. Tony DeSpirito, straight to you, sir. GM for the best part of a decade. That stock, dead money. Ford for the best part of a decade. That stock, dead money. Are these names investable, Tony, from your standpoint? Tony DeSpirito?
Yeah, so I'll comment upon the auto companies generally. Look, it's actually, forget the stock prices, look at the earnings power. The earnings power of these businesses has done quite nicely, despite the flat stock prices. And so to me, I actually see some opportunity there, particularly when you run any kind of sum of the parts math. You know, take any kind of investments, in overseas businesses, U.S. business, their auto finance business, add that up. And these businesses are trading at substantial discounts, right? There's a lot of fear over wages and whatnot, but even when you take that into account, I think there's a lot of opportunity in the auto sector.
Tony Dwyer, your take.
Well, until rates go down, I don't think you're going to get enough of an increase in demand to surprise to the upside in earnings, as Tony mentioned. That the earnings are up, but the earnings power is there, stocks are flat. So it's going to take something different. And I think for this, as well as all consumer space, I think you're going to need a much lower interest rate environment that increases. Remember, John, that when we go into recession, the market bottoms during the recession, not because the data is great, but because the lower interest rate environment improves the outlook for money. You know it's going to get better when interest rates are significantly and sustainably lower. You really need that to kickstart the consumer space, whether it's autos or other areas.
Tony Dwyer, you know the sequence of events. You throw up bond yields, they start to hit equity markets. The pressure builds on some of those corporations to do something about margins because revenue's not so great. Where's the margin expansion going to come from? Tony Dwyer, at names that may have to confront 40% wage increases in certain parts of their labor.
That's been one of my issues, John, is that S&P operating earnings are seeing a double-digit or near double-digit margin. It never was a double-digit margin prior to 2019. So the point for us is that margins see a little bit of pressure when costs go up, but the real dropper for margins, the real margin pressure, comes with lower demand, and that lower demand takes place with higher interest rates that increase the default rate assumptions and really just the cost of labor, cost of energy, all of those things. When you drop revenue, you can't cut costs fast enough. And I think we're about to embark on that period. So our mandate right now, as you know, has been light and tight. A little extra cash, more defensive posture, looking with the average stock in the NYSE down 30%, John, I'm not looking to get negative here. The time for that was last year. We're looking to stay out of the way and to attack as prices come down when bad news becomes bad news.
Tony DeSpirito, I've got about 30 seconds left on the clock. Final word, please.
Yeah, so I go back to this concept of where the pain's already discounted versus where it's not. And Tony Dwyer said that, most companies are down 30% from their peaks. I think that's really substantial. And so I'll go back to the auto example you gave. Yeah, are earnings under pressure from wages? Yes. Do rising rates mean we won't see higher vehicle sales? Yes. But what's the earnings ratio today? The PE ratio is 5 times current earnings. You don't need any good news to like these stocks. You just collect cash flow and you'll do quite well. And I think that's what to look out for. Buy quality businesses at good prices and you'll be fine in this market.
Tony DeSpirito, thank you, sir, for your take. Tony Dwyer, to you as well. Tony, your equity market on the S&P positive by 0.4%. The opening bell about 7 minutes away. Coming up in the morning calls and later, RBC's Amy Wu Silverman joined us around that opening bell with her thoughts on why tech exuberance is waning. That conversation just around the corner.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
3-month lows on the S&P 500, just a little bit of a bounce on the S&P, up by 0.4%. As the price action, here's some morning calls. First up, TD Cowen initiating coverage of Levi Strauss with an outperform rating, seeing the company well positioned to grow direct-to-consumer engagement. HSBC upgrading DocuSign to hold, seeing the company making progress in stabilizing revenue. And finally, Gordon Haskett downgrading Burlington Stores to hold from buy, 137 price target, citing links to the company's Q4 same-store sales growth view. Coming up on this program, we'll turn to tech with RBC's Amy Wu-Silverson. That conversation is coming up next.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
High-end conversation about Travis Kelce in the commercial break that you don't need, believe me. Your equity market futures bouncing by 0.3% on the S&P 500. On the Nasdaq up by about 0.25. 3-month lows on the S&P, the lowest since June 7th. We're trying to bounce. Let's your opening bounce, switch on the board and get to the bond market. Bonds taking a bite out of this equity market worldwide. Yields on a 10-year. Cycle highs over the last couple of days. 451, pulling back a couple of basis points this morning. In the FX market, the dollar strength sticks. The euro weaker, 105.31 on euro dollar, negative 0.4%. The dollar at the strongest point of the year so far. Dollar yen pushing 150, 149.20, and crude. Even with the dollar strength, commodities breaking out, 92.38. Crude right now up by more than 2 percentage points. That's the cross-asset price action. Your opening bell about 30 seconds behind us. Your equity market open looks like this on the S&P, up by 0.3%. On the Nasdaq, up by 0.4. One stock to watch at the open is Paramount. The company in focus after the Screenwriters Union approved a new contract with the studios and ended their strike. Other Hollywood-tied stocks, including Warner Brothers, Disney, Netflix, also taking center stage. Abby has more. Hey, Abby.
Hey, John. Well, at 12:01 LA time today, the 5-month dispute, bitter battle between the Writers Guild and the big entertainment companies, it ended as the Writers Guild, screenwriters, did approve a deal. Now, they got the 3 big demands that they wanted. First, they got a pay boost. They also have a piece of the action for some of the streaming shows that do especially well. Second, shows will have appropriate staffing level. And third, they've received a reassurance that AI will not be replacing their jobs. Now, the stocks are up modestly this morning. I think, John, what folks, investors are really waiting for is the possibility that this deal could suggest that the SAG strike, this, of course, is the first time in more than 60 years that both of these entertainment unions had gone on strike together, that it will be resolved. And that could really help out Warner Brothers and Paramount in particular. Since the strikes, these 2 strikes have started, roughly Paramount down 50%, Warner Brothers down about 20%. So an overhang could be removed. And right now we do actually have a pretty decent rally, up more than 1% for most of these stocks.
A decent pop there. Abby, thank you. Early days, about 2 minutes into the session. Let's turn to EVs. Rivian gaining after Baird analysts named the company, quote, a bullish fresh pick. We see Q3 deliveries as a near-term catalyst and expect sentiment to improve. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. It's been a short-lived open for Rivian, now basically flat, having been as high as 1.8% following the market open. Yesterday, the stock jumped by the most amount a month after that RBC note. What they're focused on is quarterly production and delivery figures. You'll remember that Rivian recently raised guidance by a modest 2,000 units to say they will produce 52,000 electric vehicles this year across their 2 consumer brands and the delivery van that they build for Amazon. But there's always been a debate about how conservatively Rivian's been playing this. You'll remember, John, that I reported in March that Rivian had told staff that its manufacturing blueprint, its plans, showed that they were capable of building 62,000 EVs this year, 10,000 more than they're currently guiding. So the question, I guess, is how much further above guidance they're going to go. This is an EV name, pure play, that is kind of not in the same category as the other startups that have struggled. But remember that they have a plant in Illinois that is capable of building 3 times what their current guidance is. There are questions about demand, but recent commentary from executives, the CFO and CEO at investor conferences has been quite bullish about the demands that's out there, particularly bearing in mind that the two consumer brands carry a premium price point. This stock's up 22% year to date, John.
Pretty muted price action this morning so far. Ed, thank you in the first 3 minutes of the session. Let's shift to retail. Costco fluctuating despite an earnings beat. The big box giant staying silent on the timing of its increase in membership fees. Simone Foxman on this story. Hey, Simone.
Hey, John. Yeah, Costco pointing now a little bit higher after some post-market losses after these earnings came out yesterday. There's a bit of a mixed bag here. Earnings per share beat analyst expectations coming in at $4.86, but comp sales coming in a little bit weaker than anticipated, especially when you include the impact of currency and gas. Overall, we're looking at 1.1%. The street had been looking for about 1.8%, especially seeing a little bit more weakness in the United States. The company's saying it's seeing those customers trade down big ticket items, purchases still weak. So a lot of the interest there on the lower margin stuff, the food and that sort of thing. Shrink, however, not a big issue for Costco. Markets have been focusing, and maybe we're focusing yesterday as we saw some of those post-market losses, on what was not being said. The company did not talk about a fee hike. That is something that some analysts wanted, but people in the store is encouraging traffic growth more than double what Wall Street had anticipated, and the number of paying card holders coming in at 71 million. Again, that's up almost 8% from a year ago. Read those fee hikes, the CFO saying it's a question of when, not if. Surely markets would like that to be sooner, but we're already looking at shares up 21% year to date, John.
The hot dog is still $1.50. Am I right? Is it still $1.50?
You know, I haven't been to a Costco and bought a hot dog recently. So
okay, that's a big deal at Costco. Anyway, Simone, thank you. Thank you very much. Let's stick with Costco. Cowen raising its price target on the stock to 680 from 600. Analyst Oliver Chen saying this: we believe Costco is well positioned to continue delivering robust earnings growth over the near to medium term, driven by square footage growth, membership revenue growth, and industry-leading comms growth on strong physical and digital momentum. That stock is up by about 0.1%. I want to turn to entertainment. AMC expanding a screening of Taylor Swift's concert film to more than 100 countries beginning October 13th. Katie Greifeld has this. Hey, Katie.
Hey, John. Yeah, great news. If you can't catch it in North America, like you said, about 100 other countries will also screen Taylor Swift's Eras Tour moving beginning October 13th. I'm sure I'll see you there. Now, tickets for the international locations, they went on sale yesterday, and prices vary by country. And this is a big deal for AMC. Remember, when this movie about the tour was announced last month, it was met with record-breaking demand. It actually, in the first day, saw $26 million in ticket revenue, and that is the highest advanced sales revenue in AMC's 103-year history. And AMC, it needs some good news. Remember, the company announced plans to sell up to 40 million shares earlier this month after getting those court approvals. That has shares down 37% this month alone, and not a single analyst tracked by Bloomberg has a buy rating on the stock. But the Taylor Swift movie coming soon.
You're not going to see me there, Katie.
I don't know.
Just for the record, you're not.
She's the voice of a generation, John.
It's not going to. Okay, Katie, thank you. Thank you. Katie's going to be there, basically, is what you're hearing there, based on that delivery. Katie, thank you. Let's turn to the bank. Serious story. Not that that wasn't a serious story before I start getting hate mail about Taylor Swift. Bloomberg learning that the U.S. Justice Department is stepping up its probe of Credit Suisse and UBS over suspected sanction breaches. Shonali Basak has the latest. Hey, Shonali.
John, when you look at what is happening now, you have the Department of Justice going to UBS officials and saying that there are these suspected violations when it comes to Russian clients over at the Credit Suisse wealth manager. Now, this is a classic problem. When you buy somebody's house, you don't know always what's in it. The UBS CEO Sergio Armati has moved very quickly through the summer to resolve a lot of outstanding investigations when it came to Credit Suisse, amounting to fines in the billions of dollars. We're talking about fines tied to Archegos, fines tied to pre-2008 RMBS matters. So coming into this new era of a potential new investigation that is still in its early stages leads to an overhang for Sergio Armati that is quite unwelcome. Now, we don't know the scope of what this could cost them in the longer term, but remember, as we've been saying, this is in the early stages of an investigation, and it ties back to a larger issue that the Department of Justice has privately voiced. According to Bloomberg's Hugo Miller and Ava Benny Morrison, this is a frustration at seeing Switzerland not doing enough to enforce sanctions when it comes to Russian individuals in this era. So we have a larger issue at play, and UBS is certainly caught up in it.
Shonali, just help me understand this a little bit more. Are these failures at Credit Suisse, which ultimately UBS inherits, or is UBS in the firing line as well for things they've done previously before this acquisition even closed?
It's a little bit of both. According to our reporting over at Bloomberg, it's largely Credit Suisse. But you have to remember, UBS apparently, according to my own sources as well, has known that there could be issues in the wealth manager when it comes to their clients. They didn't know the extent of what all those issues would be. And UBS itself, they are looking at UBS. Remember, this initially started as a sweeping kind of a set of requests to a larger set of banks. UBS is definitely being looked at as well, but largely these issues are tied to Credit Suisse.
So, Shonali, as far as I understood, Sergio Armati and UBS gave up that state guarantee for legal fees that they agreed to several months back in the spring when this deal was basically explained to us all. Shonali, why did they do that? Did they not have a decent understanding of where this might be going?
Yeah, they did not, and that it was part of the problem. Remember how quickly this deal came together, John? There was a very implicit understanding. I also will have to say that for all of these companies that are pushing so heavily into wealth management, this is the ugly side of wealth management, and it is something that Sergio Armati, Colm Kelleher, they know that this could be an issue moving forward. They did not know the extent of the issues. And again, this is another thing that they could face as an overhang for months ahead.
Our chief Wall Street correspondent, Shonali Basak, breaking that down for you. About 9 or 10 minutes into the session, that stock, of course, trading over in Swiss trading, but here in the United States, we're down by about 3% or so. I want to turn back to tech. Amy Wu-Silverman of RBC Capital Markets noting a decline in, quote, tech exuberance, writing this: when we dig into what the options market is pricing for mega cap tech, it is mostly that bullish sentiment has waned. Amy Wu-Silverman joins us right now, I'm pleased to say. Amy, you were warning about higher volatility. Here it is. Is there more to come?
Here it is indeed. And yes, unfortunately, I think there is also more to come. Look, even if we strip out everything that's going on, John, UAW, debt ceiling, geopolitics, it's just seasonally a very strong month for volatility in October, going back 20 years. This is typically a time when you see volatility picking up. And unfortunately, we have a lot of muddle through catalysts to go through, which suggests to me that we're still going to get that bid in volatility.
Got all these headline risks on the horizon, including the shutdown. Is that something you're focused on at all, Amy?
Yeah, unfortunately, I wish I didn't have to. I feel like we watch this movie again and again and again. And we kind of have to just go through it. But I just want to remind folks that, in 2011, this was an issue that brought the VIX to 45. I don't think we're going to get there, but the problem is because there is historical precedent for some of these spike type events, you just can't ignore it. You have to muddle through with it. And hopefully it's something that we can just digest. But until we actually do digest it, the market certainly has to price that into its volatility surface.
Amy, Mike McKee was on the program a little bit earlier this hour, and he was talking about the data points we might not get if the government does shut down. Does that, do you think, put even more emphasis on the bank earnings we get later in October, in the middle of next month?
It certainly does. And the other thing I think it does is it's going to change what we seasonally expect in the later months of the year. So just as October of the last 2 decades is a time where volatility picks up, usually we get a decline in volatility in November, December. But if we're going to push forward these data points and you're going to get them all at once later in the year, unfortunately, I think the market has to brace itself for even a higher VIX in those later months as well, John.
With that in mind, what are you advocating for with clients at the moment? What are you suggesting they should do?
Look, this has been a struggle for, I'd say, at least the last 2 years where puts Q has been underperforming and hedges haven't really been doing well. I think the major difference now is if you look from 2 months ago to now, folks have jumped in the pool, so to speak. There's much more participation in areas like mega cap tech or just overall in the market than there was before. And so, look, you have something to hedge, and those hedging levels have been extremely low this whole time. And I know that's sort of a boring thing to talk about, but at least there are events now to catalyze that low volatility where I think that didn't exist in the summer.
What have they been hedging, Amy, when you think about it? I know you've picked out, let's say, Apple and the bearish sentiment around that name. Is that about rates in the bond market? Is that about China? What is that about?
Yeah, so it's interesting. In Apple in particular, this is a name where if you look at mega cap tech, if you look at that Magnificent Seven, most of what we're seeing in option sentiment is just a decline in exuberance. So folks just aren't that bullish anymore. Whereas in Apple specifically, you are seeing hedging. You've seen that even with the 10% move down in Apple. I think that's very China related, but I also think it's the fact that, again, you had that massive move in participation. And now because you have that length, that's continuing to be there as you get data points in China. The other areas we're seeing are stratified. So you're seeing hedging in Canada, for example, and you're seeing hedging at other parts of the market like the credit-related ETFs, but it's all stratified hedging, John. It's nothing where I can say the full-on market level SPY, IWM, they're seeing a lot of pickup in demand there.
I think we can all appreciate how frustrating it is to talk about the potential for a government shutdown. Amy, appreciate the update. Amy Silverman there of RBC on the potential for a shutdown and everything else going on at the moment, looking for higher volatility. About 14 minutes into the session, equities up here by 0.25% on the S&P, on the Nasdaq bouncing back by just 0.5%. Coming up, we'll talk about it. Lawmakers scrambling to avoid a shutdown.
We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Team coverage coming up next.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. take a daily deep dive into risk, and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
We'll be bringing up 4 of the appropriation bills we've been trying to do since July. Finally, we got the members together to be able to make that happen. If we're able to finish those 4 along with the ones we already, that would make it 73% of all the discretionary funds that we're supposed to appropriate for this time. We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Speaker McCarthy fighting for his party's votes as the House and Senate charge ahead with rival spending bills. The U.S. still on track for a government shutdown at the end of the week, despite incremental progress. President Biden playing the blame game, saying, quote, funding for the government is just a basic responsibility. It's time for Republicans in the House of Representatives to start doing their job. Economic fallout of the potential shutdown expected to grow the longer it lasts, impacting everything from federal salaries to GDP to the next Fed decision. Let's get your team coverage. Bloomberg's AMH in Washington and Ira Jersey. Anne-Marie, where is this one going?
Well, Jonathan, as you said, it's incremental steps at the moment, baby steps to potentially keep the government open. But the track that they're on, it does look very likely that the government will be shut down come October 1st. So you have 2 different issues at play here. One is the Senate side, and they are putting forward their own stopgap funding bill. I call it very vanilla in terms of what's in it. Keeps the government open just 6 days before Thanksgiving, so through November. And it does come with some Ukraine aid and some disaster relief aid. The issue is Speaker McCarthy can't put that on the floor because those hard right members of his party, like Matt Gaetz, already says that there'll be a motion to vacate, a.k.a. fire him. So what Kevin McCarthy is trying to do on the House side is show goodwill to some members of his party. They were able to get through late last night just getting bills on the floor to debate. That's something he wasn't able to do last week. And he says once that's through, these are full year spending bills. Once that's through, they'll look at a continuing resolution, a stopgap measure. But it comes with deep cuts in discretionary domestic spending, as well as immigration provisions that the Democrats will not sign up for. So then there's potentially this third option, Jonathan. It's called a discharge petition. And what you could see is some Republican moderates signing up with the Democrats, basically over Speaker McCarthy's head, taking control of the floor and voting through pretty much a clean stopgap measure. The issue is, Jonathan, this has happened only twice in this century. So it's anyone's guess on how this gets done this weekend.
Fun and games, it's always a mess. Ira Jersey, whenever I try and talk to people about this at the moment in the market, they just shake it off. They don't want to talk about it at all. Ira, what can we take away from this that means something to what you do every day?
Well, I think there'll be some volatility, and presumably one of the outcomes of this will be slightly slower growth in government spending over the next 4 or 5 years. And that ultimately might be modestly good for the Treasury market, because one of the things that's pushed Treasury yields so much higher of late is the idea that, and the fact that we're getting larger deficits than the market was originally thinking. So there is a potential positive outcome for Treasuries in this whole mess, but at the same time, it's very uncertain, and clearly volatility in markets might pick up a little bit. Something important to note, though, John, is that this is not like the debt limit issue that we had back at the early June. We're not talking about defaulting on the debt. We're not talking about treasuries not being issued. The Bureau of Public Debt remains open. The Federal Reserve remains open, and we will continue to roll over debt and issue new debt as well. So that is a whole thing is off the table.
Anne-Marie, final word on the GOP debates a little bit later. Is this going to be a feature of that conversation, fiscal austerity?
Oh, absolutely. Fiscal austerity, and also what these individual candidates would do in terms of their advice for their Republican Party in the House especially. And Jonathan, we've seen a wide spectrum of that. We know from reporting that Governor DeSantis has been calling some of them, saying, yeah, maybe potentially shut the government down. The former president, Donald Trump, who won't be there, be doing his own counter program, which we spoke about earlier, in Michigan, he said, hold the line, shut it down if you don't get everything you want. And there's going to be others like Governor Nikki Haley, which says we have to keep the government open, but we need to also make sure they're doing their jobs in terms of fiscal health for this country.
The Fox Business hosting that one a little bit later. Want to watch. AMH, thank you. Alongside Ira Jersey there on this bond market. Your equity market, better than yesterday, that's for sure. So far, at least. Let's see if this sticks. About 22 minutes into the session, we're positive here by 0.3%. Let's get you some sector price action. Here's Abby.
And John, based on the bearish action we've had recently, that's just the second up day in 7, but let's see if these gains hold. And sector-wise, it suggests that maybe that could happen. The composition is not so shabby. Energy, the best sector, up 1.3%. We also have communication services, real estate, tech up there. Utilities and staples and healthcare are among the down sectors. Actually, healthcare just flipping slightly positive. Those are defensive, so the fact that they're down, in a way, that's risk on. Over the last 3 months, though, John, and of course we are coming close to the quarter end, most sectors are down. Energy up with oil. Communication services also higher. But take a look at those rate-sensitive sectors. With yields going higher, those dividends look less well. Those sectors are worse, even down more than technology.
Abby, thanks for that. Your update up next, the calendar for the week ahead, your trading diary, just around the corner.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
5 minutes into the session, stocks higher across the board here. Outperformance on the Russell of small caps, the S&P up by 0.3%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Donald Trump speaking to current and former UAW members at 8 p.m. Eastern as the second 2024 GOP presidential debate kicks off at 9 p.m. Thursday, the Fed speak, picking up with Chairman Powell, Goolsbee, Cook, and Barkin. Plus, we get US GDP and another round of jobless claims. And finally, the government shutdown deadline coming at midnight Saturday. I'm sure you can't wait for that. About 26 minutes into the session, your equity market just about positive by 0.3%. Thank you very much for choosing Bloomberg TV. Good to be back in a seat. Thank you very much for all the feedback over the last week as well. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally
globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to get the latest reporting out of Detroit. What's happening with the strike against the automakers. Plus, Joe Mazzola, he's a managing director, trading education at Charles Schwab. He's going to join us to discuss investing strategies, and he's going to give us his market outlook. Jackie Bowie, managing partner and head of EMEA at Chatham Financial, will just join to discuss the outlook in a recession scenario. I guess for some, that's back on the table. Let's kick things off here with Mr. John Tucker.
All right, thanks, Matt and Paul. Routing stocks taking a bit of a pause this morning. NVIDIA, Alphabet, ExxonMobil, the leaders in the S&P 500. Costco shares up close to 2%. They had their earnings report after the close. Yields near 16-year highs. They sent stocks tumbling earlier this week. Avery Sheffield at Rockefeller & Company says, don't expect yields to come down significantly anytime soon.
The Fed is likely, I think, to potentially stay higher for longer until something breaks. Because if something doesn't break, there is a risk that inflation could reaccelerate.
All right, so the Dow just turned lower, down 12 points right now. S&P 500 up just 7 points. The NASDAQ 100, 47 points higher. That's up 0.3%. Minneapolis Fed President Neil Kashkari says a government shutdown or the auto strike may slow the economy for the Fed. And if that's the case, the central bank would have to do less with monetary policy. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio, live streaming on that YouTube thing. So go to youtube.com, search Bloomberg Radio. How about
It's only Wednesday.
Yeah.
This is already set to be the longest week of the year.
Well, I mean, like when you work 5 days in a row, it tends to add up here. I mean, you don't have like a random vacation, thing thrown in there.
You set yourself up for that.
Exactly. I meant it feels longer than it is already.
Because of the
consecutive days thing.
The markets are like killing me, right? Monday we were set to be down. Everyone was worried about higher for longer. Then we closed up.
Yep.
Yesterday we're getting routed again. Today we're up for,
15 seconds.
The headline on the Stock Store Markets Wrap story says, stock rout pauses as traders await Fed speak. That's why they're bidding this market up?
Well, you can pretty much find any reason. So,
very creative writers.
Insert your reason here.
Let's go to somebody who actually does this for a living, Abigail Doolittle. She covers all the markets for Bloomberg television and radio. Abigail, what are you looking at in this market today?
Hey, well, I would have to say that you all do it for a living, too, looking at these markets. This gain on the S&P 500 at this point, not all that impressive, up just a little bit more than 0.1%. So it's to be seen whether or not this gain sticks around. From sector composition standpoint, energy is the top sector. That's about the top sector over the quarter. We're almost at quarters end. Energy up about 1.6%, with oil back above $90 per barrel. In fact, WTI crude comfortably above that level at close to 93. The bottom sectors, utilities, consumer staples, financials, those are all defensive sectors. So the sector composition is actually bullish. Risk on, I would say, from that standpoint. Very interesting. What's catching my eye right now, volume is 20% below the 20-day average. Right now,
I can feel that. I feel that.
Well, yes, it feels kind of slow. I think that I don't know so much that it is that investors are waiting for the comments, the minutes. It's just sort of a truce right now. We've been in this bull-bear battle now for a few months in a range for the S&P 500 and the other indexes. So they're waiting for the next big piece of information.
Well, the S&P 500, if you go relative strength index, boy, we're right at the bottom. I'm thinking about going and ask my portfolio manager for some more capital and go long this market. I mean, that RSI.
You're going to say why, Paul, and say because of technical analysis.
Exactly.
Let me take a quick look, because the last time. So I think that you probably want to do that once well, actually, let me back up. I do not give investment advice. I make observations, and then people can do as they like. But which I know you know. But just for as a disclaimer, having been in that
It's
business
always
for a
good
while,
to give that disclaimer.
Yes, indeed. So I would say the S&P 500 is probably going to nail its 200-day moving average, which is at 4196, right below 4200. The RSI is, I think it could hang out there for a little bit longer. It doesn't look like it's going to be a quick
clearly
pivot high.
range bound as this market feels. Although we had Dennis Gartman on earlier on surveillance, 85% cash.
Well, you know, it's really interesting. Doug Kotok of Cumberland, he's 30% cash. For an active money manager who's managing other people's money, to have 30% cash is outrageous. I mean, you just have, if he's wrong, he has no chance of ever catching up with the benchmark.
Wait, you mean David Kotok?
Mm-hmm.
Yeah. Okay.
Oh, what did I say?
Doug.
Oh, yes, David Kotok. Yes.
Not to be confused with Doug Cass.
Yes, not to be confused with Doug Cass, who I'm betting is probably in an equal amount of cash. I have no idea, but he's he's a market mover for sure. I think that S&P 500 though does go a little bit lower to 4,200. In fact, Samantha Leduc of Leduc Trading the other day on Options Insight was pretty keen on the idea that there's a lot of different markets suggesting that the S&P 500 is going to go to 4,200. The question then is, does it hold or does it not? I think that it probably briefly would not, and then we'd have to kind of reevaluate. We of course have earnings season coming up.
Yeah, but right now we have nothing. There's
nothing.
We're in a stalemate, right? Because there's no movement on the UAW strike. It's also not, a full-on strike. So it's just sitting there. The government is going to shut down, but I feel that literally no one cares. The Fed isn't going to come back until November, right?
I think we have what we have really, and it's not an event, it's not a piece of news. We have yields. Are yields going to continue that
and
climb
oil
higher?
prices
And oil
the dollar.
prices.
Yes. So you do see some asset classes that are moving around.
A bit more of a macro.
In significant areas, but
yeah, the Fed doesn't meet until November 1st.
Yeah.
Oh, I didn't know.
I mean, there's still data points coming out, right? We're going to get
CPI,
PCE,
jobs,
a whole bunch of stuff. Assuming the government doesn't shut down, right? Because then we're not going to get
then
a
we're
whole
not going
bunch
to get
of
the data.
stuff.
Yeah.
What's Michael McKee going to do? If there's no government data for him to do. I guess just go on to some exotic conference that he always goes to.
He'll prove that we can still talk about these things all day long, even when they don't come out.
He'll talk historical points and what it could be, should have been,
Do we
will
have to
be
pay for
when
that?
it does come out.
I think we send him on a little vacation. All right, Abigail, thank you so much for joining us. Abigail Doolittle, she covers all the markets and we appreciate that. Talking about this strike, I don't know, Matt, the two sides. I mean, we had the president out there yesterday. Former President Trump's going to be out there today, neither of which means much, I don't think. So it's just a question of some of these big issues like this defined pension thing.
I feel like
these guys are digging their heels in on
I feel like President Biden getting on the picket line, to me, that's a big deal. A sitting president going and joining in with the union and saying, come on, you got to give it to these CEOs, Right. Stick with it, right. He says on, day 12 of the strike. So I guess this could go on a lot longer. The last strike, I think 2019 was like a 40-day strike against GM.
Right. That's no bueno.
But let's talk to someone who does this for a living.
We do. We've got that person, Craig Trudell, Bloomberg Global Autos editor, based in London, but now for some reason he's in Detroit.
Well, and of course,
because they make cars in Detroit.
Well, no, because they're covering the biggest event in the global automotive industry. We should point out that Craig has lived in Detroit previously. He grew up, I think, in Michigan. And
went to Michigan State. A little problems with their football program.
He's a Sparty.
Yeah, problems with the football program.
But he's covered autos on this continent. He's covered them out of Asia. He now is normally in Europe, so globally. And how does this strike compare, Craig, to the others to the numerous strikes that you've lived through?
Guys, I'm really glad I'm not talking Michigan State football. I think this is absolutely unprecedented. I mean, the union, its general sort of approach tends to be to really kind of single out one company, the company that it thinks it can get the biggest pound of flesh from. If it's unable to reach a deal with that company, it goes on strike, and then once it hammers something out with that one company, it then patterns the agreement with the other two. This has been a very different strike. I do think that, as was alluded to earlier, it has been fairly limited in terms of, the amount of impact that it's had. They have been choosy about, which factories they're striking at. It's just, one car factory per company at the moment. On Friday of last week, they, did ratchet up the pressure somewhat with a strike at parts centers for General Motors and Stellantis. But this does have the potential, I think, I would absolutely agree, it has the potential to drag on for quite some time. I think that's really by design on the part of the union, that they want to, make their strike fund last and hold out for a deal that they're happy with and confident about, getting ratified by their members. And so, I do not foresee the strike wrapping up anytime soon, and it may, continue to be very different than anything we've seen before, because it's been really difficult to see around the corners of where this is going.
And Craig, one area, just from my reading, that I suspect is going to be a real problem to get resolved is this whole concept of defined benefit pension plan, which, a vast majority of Americans don't even know what that is because it hasn't been around for generations. But it's still a thing in the auto business. How do you think that plays out?
For some workers.
For some workers,
and for the
right?
CEOs.
Yes.
But not for all workers, right?
Yeah, I think, in terms of things that the companies I can foresee digging in on most, that is absolutely up there. I don't think that there's any desire whatsoever on the part of these companies to go back to the way things were with this respect. And I don't necessarily know that it would be the sort of thing that the union would dig in on most. I think it's, by all means, it's something that they, might as well try to get away making an effort there. But in terms of, what the likelihood of this remaining, on the agenda in terms of, at the bargaining table, it may go the way of, the 36-hour work week or the 40% wage increase. I think that the union has bent on both those fronts thus far.
I think it's, though, the most interesting demand. Yeah. And, the pay increase, they probably deserve that considering how much they gave up before and what inflation has done to, the usefulness of the money they do get. The shortened work week is like kind of silly, right? But the pensions is something they had, and pre-2008 employees have that. Mary Barra has it, and I think, I'm guessing Farley has it too because he's been there for so long. And the reason they don't, in a great story by Joe Constance and Josh Idelson, they laid out probably the biggest challenge is the accounting standards, because they account pensions and other things like investment in employee training, for example, as a cost without giving any consideration to the value. I think it's really interesting, not that they would change the accounting standards, but this makes it less attractive to companies. Really, they're going to fight hard against it. Is there any chance that the unions, maybe even working with the White House, President Biden was there with them, can get this changed?
I do think that it was interesting that even when, Biden was on the picket line yesterday and was asked about, whether UAW members should receive a 40% increase, I thought his answer was interesting. He said, yes, I think they should be able to bargain for that. I think it got, shorthanded as yes, he thinks that they should receive 40%. I think that, one of the things that has been really interesting is the extent to which, the White House has wanted to some degree to get involved here and wanted to try to be helpful. I think, I was actually a bit surprised that the UAW invited him to the strike, just in the sense that I think there is some concern on the part of the membership of, political involvement here. I think, whether or not the White House is really able to actually exert itself at the bargaining table, I think the UAW is somewhat reluctant for them to play that, hands-on a role. And I'm sure that the companies are not particularly interested in a third party at the table either.
But they don't mind if you're handing out billions of dollars in subsidies, right?
This is true. But even there, I think it's very interesting that, the amount of money flowing into this sector, as a result of the IRA and various bills passed under this administration. There's so much money going into battery manufacturing, into electric vehicle manufacturing, retooling of existing factories. And yet, there have been bones that the union has picked with this administration over how that money is being doled out, and whether or not it's being set aside explicitly for plants that are unionized. And so, while this union absolutely sees in Joe Biden an ally, and particularly relative to Donald Trump, I think the president, UAW president, has made no bones about that. I do think that there is still, a pressure that the union continues to put on this administration to go even further than it has already. I don't know necessarily that they, want Biden at the bargaining table. That said.
All right. Any sense here? You're in Detroit. You're talking with the people on the ground there. Any sense on how long this could go?
I think, one of the interesting, things to watch is just going to be the extent to which, Ford may have a sort of setback here this week as a result of having pressed pause on a battery factory that they were going to build in Marshall, Michigan. And the union really did not take kindly to that announcement. It was at least looking like, the smoke signals out of Dearborn was that the union and Ford were making some progress, and they said as much late last week. But for the union to really sort of, react the way it did, it will be very interesting to see if that is a meaningful setback and slows things down. I think the key is going to be, much as this has not gone the way it has in the past, if the union can get a deal with one of these three companies, I do think that it, maybe helps us kind of get our arms around just how long this is likely to drag on.
All right, Craig, thanks so much for joining us. Appreciate getting the update there. Craig Trudell, he covers all the global autos for us. He's in Detroit at our Detroit bureau. It's where he needs to be because that's where the action is. President Biden there yesterday on the picket lines. Former President Trump is going to Detroit today. Not sure of his agenda today, but certainly both leading political people of their party are kind of getting out to Detroit and kind of putting their 2 cents in, whether it's wanted or not. But just listening to the rhetoric, Matt, it sounds like these two sides are still very far apart.
Yeah, it does. And so my question would be, are they going to expand the strike out to other factories? Yep. Because so far, as Craig mentioned, they're only striking parts plants and the Bronco, the Colorado, and the Wrangler.
Yep. I like to talk to a big dealer to see kind of where we are in terms of inventory, and because that's when the dealers start
so far so good. I talked to George Kaufman from Buyers, which is a huge collection of dealerships in Columbus, and he said so far so good, but they're worried.
They're worried. All right. Well, keep an eye on that, and of course, Bloomberg will have all the latest reporting. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. Shares of UBS are falling after a report from Bloomberg that the Justice Department is stepping up its probe into the Swiss bank and Credit Suisse. It's reportedly over suspected compliance failures that allowed Russians to evade sanctions. Bloomberg's Hugo Miller explains.
This is more a case that fundamental compliance failures, when you onboard, to use the bank jargon, a client, or when you offboard a client, you have to make sure that you're doing the necessary compliance. And in this case, as we've seen in a number of other cases with Credit Suisse, in this case, what the DOJ suspects is that there were just some fundamental failures of due diligence that allowed the bank, primarily Credit Suisse, to continue to provide banking services for sanctioned Russians.
Shares of UBS right now down about 3.5%. To entertainment, where shares of AMC are higher after the movie theater chain said it's expanding its screening of the Taylor Swift concert film to more than 100 countries. Bloomberg's Katie Greifeld says AMC could use some good news.
Remember, the company announced plans to sell up to 40 million shares earlier this month after getting those court approvals. That has shares down 37% this month alone, and not a single analyst tracked by Bloomberg has a buy rating on the stock.
AMC right now down about 0.6%. And streaming video providers are joining forces to form a new trade group. Netflix, Disney, Warner Brothers Discovery, Paramount, and others. They've created the Streaming Innovation Alliance, and that's to promote their interests to politicians and government officials. Missing from that list, though, Apple, Amazon, YouTube, and Roku. Those are the company stories we're following this hour. I'm Lisa Mateo, and this
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, they've turned mixed right now after yesterday's sell-off. S&P 500 down 5.2% so far in the month of September. A 10-year Treasury yield, that's been in the driver's seat for the market sentiment. That hit its highest since October 2007 yesterday. Today, the 10-year, right now, it's up 1 basis point at 454, so that's leading to some of the sell-off in stocks. The 2-year yield right now, that's up 1 basis point, 5.08%. Data this morning, key gauge of manufacturing improving in September. You had factory orders for durable goods increasing last month, supported by demand for business equipment. The late great Ken Pruitt used to define durable goods as something when you drop it on your foot, it hurts.
I like that.
S&P 500, 9 points higher. That's up 0.2%. The Dow Jones Industrial Average down 1 point, 33,617. The NASDAQ 100 up 40. That's up 0.3%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in a Bloomberg Interactive Broker studio. Also live streaming on YouTube, so head over to youtube.com and search Bloomberg Radio. I mean, today's tape basically unchanged. It kind of feels kind of like where we are overall in these markets here. Feels range bound, as we've heard from some guests kind of suggest. And the question is, you know, kind of what moves you out of that range? Maybe our next guest has some thoughts here. Joe Mazzola, he's over at Schwab. He is the managing director of trading education at Charles Schwab. I mean, Joe, you're at Schwab. You guys see everybody. You see everything out there because you have so many clients out there. What do you feel like investors are kind of the biggest issue for investors right here?
I think there's probably three things that investors are really kind of keying on right now. You know, interest rates being number one. You guys just kind of led into that. You know, back around 4.5%, 4.55 in the 10-year. I don't think it's the move itself. It's the magnitude and how quickly it moved. I think that's shaken markets up quite a bit. I think the second thing is the political landscape. And, you know, there is more risk around a government shutdown. I think maybe we sit back and say, well, you know, this will work itself out. But there's real risk that this could carry on for a while and could have some economic impacts. I think the last thing, and probably maybe front and center in investors' minds, is inflation data. It did seem like it was subdued over the summer. It seemed like, people were kind of able to kind of get ahead of it and see the end in sight, but we started to see it kind of tick back up. We get PCE data on Friday, so it'll give us a little bit more of an indication on where we're at. But that's absolutely front and center for our investors' minds.
Abigail Doolittle looks at the technical analysis, and she thinks we could float down below 4,200 on the S&P 500. I guess I would imagine that retail investors look at these yields and find them attractive. Especially versus stocks right now. How are your clients trading it?
So we look at a couple things, right? We look at the S&P earnings yield versus the 10-year yield, and you look at that spread, and we're back at levels that we really haven't seen since prior to the great financial crisis. Meaning, look, that whole TINA talk that we've had for 15 years, I mean, that's out the window. There is an alternative. There's an alternative in fixed income. There's an alternative in money markets. A lot of investors are comfortable just kind of sitting in 5% yields and waiting for the market to work itself out. I agree 100% at looking at some of these technical levels right now. It does seem like, you know, we've moved into a bit of a lower range. And the reason I say that is because, you know, we broke that 43.50 range. I think we have some room to potentially go maybe down to about 42.10, where you might see a bit of a bounce. That's kind of that intersection of where the 200-day moving average is sitting right around 4,200, but we also have a Fibonacci retracement level from the one-year highs right around that level as well too. But a couple of things that I've been paying attention to, and you know, a lot of our traders and investors have been talking to us about, is this idea of the market breadth and how it's really weakening. We're just not seeing a bounce, and we're not seeing it across the whole spectrum. If anything, really the only sector that's held up well is energy, with about 90% of its components in the S&P 500 up above its 50-day moving average. But when you look at the S&P 500 as a whole, we're around 25% of the S&P 500 up above its 50-day moving average. And that's just not, it's not at a level that supports a bounce. Now, what I'd like to see is a little bit more of a washout. I'd like to see us get down maybe around that 10 or 12% level to see if we get a bounce from there. At that point, maybe some of that bullishness kind of fades from the market. You might start to see some that washout occur where buyers might start to step back in.
Hey, Joe, when you talk to the Schwab customers, what are some of the sectors that they like right here? I mean, if you just kind of look back at this year to date, if you owned, the Magnificent Seven, boy, this has been a great year. What are they most bullish on at this point, or maybe what are they most concerned about?
Yeah, Schwab customers for sure are looking at really two sectors right now: energy, and they've done well in that over the last couple months. I think if you look at a sector as a whole over the last month, it's up over double digits. And then information technology, so IT. So they continue to be buyers there. They're looking for opportunities on sell-offs to kind of step in and buy at those levels. But those are the two right now that they're really looking at. The ones that they are really shying away from are real estate utilities. Those are the ones that they're very bearish on right now.
In terms of real estate, is it a problem, with these higher rates, with higher mortgages, with refinancings coming due? I mean, both on the retail and residential and on the commercial side, there are some big question marks there.
No, I think you hit the nail on the head. I think when you're starting to look at a 30-year fixed mortgage up above 7%, 7.1, 7.15% at this point right now. I mean, just look at what we've seen in existing homes. I think 90% of the U.S. has a mortgage under 5%. What's the impetus to move to a new home? I think they're kind of sitting still, and that's cut down on supply, which to a certain extent has held housing prices in check. We haven't really seen a big decrease in housing prices, but at the same time, it's just not really providing the catalyst for people to move. Not until you start to see a real break there. I know there is some pent-up demand, and supply is starting to hit. We've seen that on the new home sales exceeding existing home sales, and we've seen that spread continue now for basically a year. But until you start to see those mortgage rates kind of tick back down, I don't think you're going to see a lot of buying momentum there.
So, Joe, the good folks at Schwab, is it your base case that we're going to have a recession? And if so, when? Or do you think we can skate past one?
Well, I can tell you what our investors and what our traders are telling us. About 69% of them do believe that a recession is coming. But they do believe that it'll last less than a year, and it might not be as deep as maybe some are predicting. I think that the belief is that it'll happen in 2024, and they're constantly looking at this battle between the soft landing a scenario and a recession, and I think they're probably skewing a little bit more towards recession side at this point.
So, do people back up into these rates? Do you buy, treasuries and even maybe go long a little bit of duration if you're worried about a recession?
Well, I'm not a fixed income guy, but I can tell you, what our traders are telling us, and they have been bearish on. Well, let me rephrase it. They've been a little bit more bearish on bonds than they were in Q2. So the Q3 survey, they pulled back some of that excitement towards bonds. But I think that what we're starting to see now is maybe a little bit movement back into that sector. And we're starting to see it, of course, on the money market side as well, too, as people are kind of waiting for a correction in the market. I think the thing that's frustrating for investors right now is it's kind of a slow grind down, right? I mean, we're not really seeing a big pop in the VIX. We're still below 20. We haven't really seen a big pop in the MOVE index on the fixed income side, which is showing that investors and traders they're not comfortable at this level, but at the same time they're not panicking either. That's why I talk about that washout. Until we see that washout, I think we just can continue to see this grind down within this lower range.
Hey, Joe, thanks so much for joining us. Really appreciate it. Joe Mazzola, he's a managing director and trading education at Charles Schwab. All right, Matt, you are not just a collector of cars, you're also a collector of leather jackets. What do you got on today?
All right.
For those of us that have the YouTube thing.
So recently,
I'm not kidding. He collects leather jackets.
Recently finished Aero leather jacket. This is the 7, which is kind of a cafe racer with a collar on it. It's made in CXL Horween horsehide. So it's very thick horse hide with a brown pigment dye. And
so there's a horse out there that doesn't have a skin because of you.
I think that horse has probably been eaten. So they used the hide for
Now, did
other
you get this off the rack?
No. It took over a year to make this thing from start to finish.
Who made it?
Arrow Leathers out in Galashiels, Scotland. And I used Thurston Brothers as kind of the middleman. It's a shop out in Seattle. So I sent them my measurements. They sent me a bunch of test jackets, back and forth with them for a while. And then they finally sent the resultant figures to Galashiels, and then Arrow made the jacket.
Probably cost you a couple $100, right?
It was a pretty penny, yeah.
Is this what you wear while riding the Indian motorcycle?
Yeah, it's one choice for riding the Indian motorcycle. Because the horse hide has such tight pores, it makes it practically waterproof, so not a problem if it rains. And because the hide is so thick, it offers a lot of slide resistance if I were to bail.
That jacket between you and the roadway, yeah, it ain't gonna work.
Fascinating. Rich, I know you're fascinated, so that's why I brought it up. All right, right now, let's head down to Washington, D.C. World and national news with Amy Morris.
All right, thank you, Paul. The U.S. is on track for an October 1st government shutdown, even after incremental progress late yesterday afternoon on rival spending bills in the House and in the Senate. We talked with Terry Haynes at Pangea Policy, who tells Bloomberg he is not expecting any concrete resolutions until at least Christmas.
That's when the defense legislation, both the authorization of spending and the spending itself, are finished. That gives the Congress time to catch up on other appropriations bills. They need to take that long because they haven't done any work on these things since May.
Terry Haynes with Pangea Policy. Senate leaders, meanwhile, have an agreement on a short-term funding measure to help avoid a shutdown this weekend. The bill has very little chance of passing the House, where Republican Congressman Bob Good of Virginia says a shutdown wouldn't be all that bad.
I've said, hey, we shouldn't fear a shutdown in the sense that we're so afraid of a shutdown that we betray the American people by failing to meet the moment and to cut our spending.
Republican Congressman Bob Good. House conservatives have said they will move to oust Speaker Kevin McCarthy if he allows the Senate bill to come to a vote. In a blow to his wealthy image, Donald Trump has been found to have committed fraud by inflating his net worth in financial documents. Bloomberg's Nancy Lyons explains.
A New York judge says Donald Trump and his company for years deceived banks, insurers, and others by hugely overvaluing his assets and exaggerating his net worth in the paperwork filed to secure financing and to make deals. The case was brought by New York Attorney General Letitia James. The ruling also applies to the Trump Organization and Trump's two sons, Eric and Don Jr., and it comes ahead of the civil trial over the remaining claims of the case, which will also include punishment for the fraud. I'm Nancy Lyons, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg.